Namaste, good morning. Welcome to this session where our intention is to complete PGBP to the maximum extent possible. Yesterday, we were having a very fair idea about the computation of depreciation under income tax law. Okay, to a larger extent, depreciation is not a standalone question, but if at all there is a question with intricate adjustments also, we will be able to do, is my opinion. And also, we saw in this process what is some case laws regarding depreciation, how to treat forex only in the year of payment. The differential will be accounted is what we saw with regard to forex. Before that, we had a big idea about income. Income under section 28 and under section 41. 28 direct income, 41 deemed income, both are taxable under PGBP chapter. How the entire income is going to be, what are all the intricate things, what are all incomes, how that is considered in section 28, especially purposes, subsidy, compensation, all those things we were looking at yesterday. Today we are progressing from section 38. If we 33, if we look at this, we have completed these two parts. If you look at this, we have completed these two parts, that is income and the asset-based deduction, where our whole focus was on depreciation. Moving forward, we go to the next one called deposit-based deduction. Deposit-based deduction. Normally, expenditure is a revenue item. If you make a deposit, you cannot claim it as an expenditure normally. But to promote certain sectors, we call it as plowing back of profits, ensuring that the profits are reinvested for the business purposes, instead of the owner taking over the profit in the name of drawings or dividend or whatever it is. If I make the owner, if I make the business entity to reinvest that profit, it will be beneficial. So came this deposit-based deduction. Keep it deposited. Use the deposited money for reinvesting in the capital asset of the business. I will give you deduction is the idea. Though there are two sections, 33AB, 33ABA. 33AB, 33ABA. ABA is not popular, not seen questions. AB is the questionable area. Section 33AB is the questionable area. What can be the question? About the deposit-based deduction, because it is interlinked with the plantation sector. So, all plantation activity has a part of the income as agriculture, part of the income as business. In that manner, it can get some importance. So, section 33AB, tea, coffee, rubber are the businesses which are there. And it is not for a trader, it is only for the person who is there in the field, growing and manufacturing. So only those who are in the field. How can I claim this deduction? If I have made the deposit with NABARD, If I have made the deposit with National Agricultural Bank and Rural Development Sector, I can get it, or any approved bank within 6 months or from the end of the year I should have. So before September 30th, I should have. Before September 30th, I should have. The honest person should certify. Okay. And what for the money kept should be utilized. That is what is important. Is it just deposit? No. The money kept deposited should be utilized for purchase of assets. The money kept deposited should be utilized for purchase of asset to be used in the field. Once more, the money kept deposited should be utilized for purchase of asset which are going to be directly productive asset. Don't buy some asset for office purposes. Don't buy assets where you can claim 100% depreciation. Now it is not there, but still when the law was made. Don't buy domestic assets. Don't buy car. Buy assets which are going to be used in the field. Buy assets which are going to increase your productivity. Of course, only one asset to be in office I will accept is computer. And the asset you are purchasing should be held by you for 8 years. The asset which you have purchased should be held by you for 8 years. If these conditions are satisfied, shall we repeat? Point number 1, for plantation sector, within 6 months from the end of the year, deposit with NABARD. The deposited money should be utilized for purchase of asset. Those assets which are used in the field only is acceptable. No office equipment, no personal assets, no non-productive assets, no asset which is enjoying already 100% depreciation. However, I will give you for computer and ensure that the asset is with you for 8 years, minimum period of 8 years. If these conditions are fulfilled, I will give you the deduction. What is the deduction? Amount deposited or 40% of profits before claiming 33AB. 40% of profits, whichever is less. Profits here means profit computed as per PGBP chapter before claiming 33AB. Suppose you sold the asset within 8 years. Suppose the money kept deposited has been withdrawn and misutilized. That is, you have not invested it in the said assets. In the year of sale or in the year of misutilization, it will become taxable. It will become taxable. The consequences. The amount kept deposited shall be withdrawn only for the purpose of utilization. Where it is withdrawn but not used for specific purpose, the amount withdrawn will become taxable. In the following cases, I will not tax: death, partition, liquidation. Whereas closure of business or dissolution of a firm, I will tax. Where the newly purchased asset is transferred within 8 years, then the deduction already provided will be withdrawn. Okay. If it is due to compulsory acquisition, that's where the transfer is to government. Okay. Remember, all these sectors come under partly agriculture, partly business. All these sectors come under partly agriculture, partly business. Major part being agriculture. Easy to remember. Tea and coffee 60-40. Tea and coffee 60-40. Rubber 65-35. Tea and coffee 60-40, rubber 65-35. But if it is a raw coffee, that is directly plucked, it is not cured or it is not roasted and grounded. If it is raw coffee, 75-25. Once more, tea and coffee, remember 60-40. But it is raw coffee. It is not roasted or grounded, it is 25-75. For rubber, 65-35, major part being agriculture. Income from nursery, sale of saplings, all these things, 100% agriculture only. 100% agriculture only. A quick read through. And 33 ABA can be a questionable area. AB can be a questionable area. ABA is never questionable area. Okay, it is for petroleum and natural gas. Instead of 40%, it is 20%. Otherwise, the same. Otherwise, the same. A quick question on agricultural income and then going to 33 AB. A quick question on agricultural income. Vivita, a resident and ordinary resident in India, derived the following income from various activities. Income from sale of rubber plants, income from sale of coffee grown and cured, that's all. It is raw coffee 75-25. Income from sale of coffee grown, cured, roasted and grounded in Colombo. Please highlight it. Agricultural income from outside India is fully taxable. Only from India we have that exceptions. Agricultural income, even we saw in non-resident taxation, agricultural income from outside India is fully taxable. Income from sale of tea grown and manufactured in Shimla, saplings, that is 100% agree. You are required to compute the business income and agricultural income. Income from sale of rubber, it is 65:35 is the ratio. 65:35 is the ratio. Okay, 3 lakhs into 65%, 3 lakhs into 35%. Okay, 65-35 is the ratio. Okay, 65-35 is the ratio. Coffee grown and cured, grown and cured. The ratio is 75 is to 25. 1 lakh means 75,000, 25,000. 75,000, 25,000. Income from coffee, grown, cured, roasted, grounded and roasted from Colombo. Remember, don't write in exam, remember. Agri income from outside India is fully taxable. Okay, is fully taxable. So 100% it is taxable. 2,50,000. 2,50,000. 60-40 is T ratio. 4 lakhs mean 60% is business agricultural income and 160 40% business income. Okay, saplings. Fully agriculture, fully agriculture. Modi, an individual engaged in the growing and manufacturing of tea in India. For the previous year, his composite business profit before allowing 33 AB is 60 lakhs. On 1st September 21, he deposited 11 lakhs in tea development account. He has a brought forward business loss of 14 lakhs. Okay. Compute income and tax payable for the financial year 2021. On 25th January 22, he withdrew 10 lakhs. Use this as under 6 lakhs for purchase of non-depreciable asset as per scheme, 3 lakhs for office premises, 1 lakh other expenses. What will be the treatment? Computation of total income. Computation of total income. We are working along. Please work along with me, but don't go faster because some intricacies you need to understand. Net profit before claiming 33 AB. Net profit before claiming 33 AB 60 lakhs. Expenditure under section 33 AB 40% of profits. Okay, 40% of profits. Actual amount deposited. Actual amount deposited 11 lakhs. Whichever is less will be allowed, my dear friends. Whichever is less will be allowed. Okay. Income after allowing 33 AB. Income after allowing 33 AB. 49 lakhs. Income after allowing 33 AB is 49 lakhs. Okay. Okay. Now please understand agricultural income 60%. So in this 49 lakhs, 60% becomes agricultural income. In this 49 lakhs, 60% becomes agricultural income. Business income is nothing but 49 lakh minus 2940 less brought forward loss. Why I am insisting is, if you do a mistake, 49 lakhs less brought forward loss and then split, it is wrong. And then split, it is wrong. Because look at the wordings. Okay. Brought forward business loss is 14 lakhs. Brought forward business loss. So my total income has to be split. The assessee is in the manufacture of tea, growing and manufacturing tea. The assessee is in the business of growing and manufacturing tea. So please understand that there is a after splitting between agri and business income only brought forward loss. Total income so two things to be understood. This is before splitting because this is a computation mechanism under PGBP. Once you compute your income, split into business and agriculture. Whatever is the brought forward loss, allow it then. Two things to understand is these things. Okay. The question as said, compute income and tax payable. Computation of tax, all of us together. All of us together. Okay. But wait. Since the assessee is an individual having both agri income and non-agricultural income, tax has to be worked out on step-by-step basis. So remember, the assessee has both agricultural income. Agricultural income is 2940, business income, taxable income is 560. So let's go step by step. Step 1. Total income by including the agricultural income. Total income by including agricultural income. 2940 is my agricultural income. 560 is my business income. My total income by including agricultural income is 35 lakhs. My total income by including agricultural income is 35 lakhs. On this, the tax will be worked like this. 35 lakhs minus 10 lakhs into 30% plus 1,12,500. Up to 10 lakhs, we all know it is 1,12,500. 0 to 250, nil. 250 to 5 lakh, 5%, 12,500. 5 lakh to 10 lakh, 20%, 1 lakh. More than 10 lakh, 30%. So 25 lakhs into 30%, 25 lakhs into 30% plus 112,500 plus 112,500 makes it 8,62,500. Makes it 8,62,500. Step 2. Basic exemption limit plus agri income tax on the same. So my basic exemption limit is 2,50,000 plus my agricultural income is 2,940. Basic exemption limit plus agriculture income and the tax on the same will be 769,500. The tax on the same will be 21,90,000 into 30%. 21,90,000 into 30% plus 1,12,500 plus 1,12,500. Net base tax is nothing but the difference between step 1 and step 2. Add HEC at the rate of 4%. Total tax payable for all of us in the classroom. For all of us in the classroom, I know this is not part of the question that I asked, but this is an afterthought. Just now I thought I can do like this also and show you. Okay, I'm just doing it. Please understand. Okay, if you don't follow it, don't worry. When we come to that, I will again explain you. But you can copy down the answer and keep it. At that time you'll understand it. For those who have seen the amendment lectures, this will be useful also. Okay, suppose if the assessee opts for optional tax regime, how will the working change? How will the working change? Okay, suppose if the assessee has gone for an optional tax regime, how will the working change? All of us, please understand. I'm trying to help you. Okay, late if you don't understand it now also, don't worry, later you can understand. Net profit before claiming 33AB, we all know it is 60 lakhs. It is 60 lakhs. Expenditure under 33AB cannot be claimed under optional tax regime. Expenditure under section 33AB, none of these special benefits are available, cannot be claimed under 33AB. Okay, under optional. So like yesterday, whatever additional depreciation, that also you cannot claim. That is the all super benefits, tax promotion benefit, incentives cannot be claimed. However, the brought forward business loss can be claimed. I'm writing it here, though I'll split and do it. Agricultural income, 60% of net profit. So this into 60% will become my agri income. Business income will be my 60 lakhs minus 36 lakhs for 24 lakhs. Less brought forward business loss. Less brought forward business loss 14 lakhs. Total income 10 lakhs. I'm just using it as an opportunity to explain you optional tax regime. Computation of tax. Step 1. Total income by including agri income and tax on the same. So total income by including agri income, tax on the same. The optional tax regime tax is like this. Optional tax regime. Up to rupees 2,50,000, here also nil. You are not supposed to pay any tax. 2,50,000 to 5 lakhs, here also it is 5%. So tax will be 2,50,000 into 5%, 12,500. 5 lakhs to 7,50,000. Okay, tax is 10%. So 2,50,000 into 10%. 7,50,000 to 10 lakhs is 15%. So next 2,50,000 into 15%. 2,50,000 into 15%. 10 lakhs to 12,50,000, 20%. So next 2,50,000 into 20%. 12,50,000 to 15 lakhs, 25%. So next 2,50,000 into 25%. The sanctity to remember is increase 250, increase 5%. 0 to 250, 0. From there, 250 to 5 lakh, 5%, 5 lakh to 750, 10%, 750 to 10 lakh, 15%, 10 lakh to 1250, 20%, 1250 to 4. So increase of 2,50,000, increase tax by 5%. Okay, so up to this point, if you look at it, it will be 187,500. Up to this point, if you look at it, it will be 187,500. So we will always say in optional tax regime, the tax working, okay, income exceeding rupees 15 lakhs into 30% plus 1,87,500. Income exceeding 15 lakhs, on that income 30% plus 1,87,500 plus 1,87,500. Here it will be 46 lakhs minus 15 lakhs. 21 lakhs, 31 lakhs into 30% plus 187,500 plus 187,500. 31 lakhs into 30% plus 187,500. 2. Basic exemption limit plus agree income. Basic exemption limit plus agree income. On that, what is the tax? So again, 23,50,000 into 30%. 23,50,000 into 30% plus 187,500. Net tax, net base tax. Step 1 minus step 2. Add HEC at 4%. Add HEC at 4%. Total tax payable under optional tax regime, okay, will be 2,25,000 plus 9,234. Okay, so whichever is beneficial, so the normal tax will be always, because of deductions and other things, the normal tax will be more beneficial than the optional tax regime. I just worked out. If you are unable to catch up, don't worry, I have optional tax regime as part of assessment of individual. One of the questions our friend has asked me is, how will surcharge be computed in the case of partial integration method? By partial integration, he means that agree income, etc. Only if the total income exceeds. Only if the total income exceeds, you will compute surcharge. Surcharge is after net tax. Not at every stage you need to compute surcharge. Our friend's question is, suppose if this is 60 lakhs, should I add? No, this is at the basic tax level only. If this is 60 lakhs only, you need to compute surcharge. If this is 60 lakhs, this total income, it is not total income by including agriculture income has exceeded 50 lakhs. Should I do surcharge? No. Surcharge is after this step. Net base tax, add surcharge. That is how it will come. Okay, I hope that is the question and that is the answer. Okay, okay. So, just want to work out some questions. We will here and there keep working this so that we remember this optional tax regime in okay. Now sticking on to the question is, for the financial year 21-22, for the financial year 21-22, what happens? according to section 33AB, amount withdrawn should be utilized for the purpose of the scheme. Where it is withdrawn but not utilized, then it becomes taxable in the year of withdrawal. Okay, the amount withdrawn should be utilized for the purpose of the scheme. Where it is withdrawn, my dear friends, but I am not using it for the purpose of the scheme, then it becomes taxable. In this case, 10 lakhs is withdrawn, 6 lakhs purchase as per scheme, amount utilized as per scheme, so 6 lakhs, so it is not taxable. Amount not utilized for the purpose of the scheme, 4 lakhs. That is, that 3 lakhs which you have purchased the office expense, office premises, and 1 lakh for other expenses, these both are not allowed. 4 lakhs. However, the class has to understand something. Is the entire 4 lakhs taxable? Means no. Again, this has to be divided into agree income 4 lakhs into 60%, business income 1,60,000. Please understand, though here we are not computing tax and all, they are not given that year's income and all, but please understand, here also, whenever there is a taxation with regard to income which is partially business, partially agriculture, when did you give the deduction here? You gave the deduction here and then only split. So whenever you are taxing again, you need to split. You did not split and then give the deduction. We gave the deduction and then only gone for the split. So whenever there is going to be taxation, it needs to be split. If it is optional tax regime, no problem. No problem. This is not at all taxable. Why? Because the deduction itself was not given. So the provisions of 33AB itself is not applicable. But don't worry about optional tax regime. I'm generally telling you. Quick. Okay, I'm not saying this is a rare area of questioning. They have been questioning on this deposit based deduction 33AB. Now, next to depreciation, the longest travel section is going to be 35, but not in one area. There are 4 areas of section 35. There are 4 areas of section 35. So let's go into section 35. Before going, section 35 has 4 parts, my dear friends. All 4 parts we are going to study. Scientific research, major. Specified business, most important. Apart from this, the lesser importance areas of amortization and social welfare deduction. Repeating, scientific research, important. Specified business, questionable area always. Those two we are going to cover a lot. We will look into amortization. We will also look into social welfare deductions and understand. Scientific research expenditure is the simplest from this year. Simplest from this year. All of us please understand. From financial year 2021, this has become simple. Why am I saying so? Till financial year 1920, there was something known as weighted deduction. Weighted means over and above what we spend. Once more repeat, weighted means over and above what we spend. Okay, they call it 150%. So if I spend 1 lakh, the law says I will add weight to it and you can take a deduction of 150. Those things are gone. Those things are gone. From this year, everything 100%. So, previously we used to split and read for manufacturing companies, for non-manufacturing entities, contribution for social welfare, contribution for statistical research, contribution for scientific research. No more splitting like that. No more splitting like that. Everything is only 100%. So the section has become simpler in its for a student. Okay, the section has become simpler. It is only 100% everywhere. Throughout income tax law, wherever they are going to give capital expenditure as deduction, which is here also, section 35 is full of capital expenditure can be claimed as deduction. One thing you cannot claim is cost of land. One thing you can never claim is cost of land. So for research also, for lab you can claim, for research equipment you can claim, but you cannot claim for cost of land. Suppose this is your first year of operation. Repeating, if financial year 2021 is the first year of operation, expenses of the last 3 years can be accumulated and claimed. Because I understand, research would have started already. Now only your outcome comes. Past the 3 years expenditure, you claim it in one shot. Remember, research need not be successful also. In later, we are going to study a case law called Priya Village Roadshow, PVR, where they are going to say the same. You conducted some study, but it does not result in a product, in an asset. Claim the expenditure. In here also, you conducted a research, the research is not successful. Does not mean you have to forego it, you can. So the expenditure can be in-house. That is, you have a R&D department and incur it. Okay, or it can also be for contribution to an outside agency. Revenue expenditure of previous year allowed. This is not a big thing. Everywhere it is allowed. So this is not the benefit. Revenue expenses of past 3 years. If this is the first year of business, okay, it can be accumulated and claimed. However, if you have paid some perquisites, it's not allowed. Don't worry about it. It's not questioned. Revenue expenditure is purchase of material, salary to research personnel, etc. Capital expenditure, here is the benefit coming, is for the purpose of research during the previous year, and capital expenditure of last 3 years, if this is the first year of operation, can be claimed. No question of claiming land. No question of claiming deduction on land. Quickly read through till point number 6. Okay. Once more, in-house research expenses, revenue expenses of last year, claim. Capital expenditure of last year, claim. If this is the first year, past 3 years revenue expenditure, claim. Past 3 years capital expenditure, claim. Don't claim cost of land. Don't claim cost of land. Yesterday I said this, I'm repeating. Sir, my research is over, sir. My research is over. I bought some asset for research. I have some assets which I have purchased for research and the research is over. I have two options. Sell the asset. Section 41. Any expenditure, losses, deductions claimed earlier, now recovered. When you purchase the asset, you claimed it as deduction, correct? When you sell it, whatever is the sale value is an income. No, sir. I'm not selling. I'm transferring it to my main business itself. We saw this also, special cases of addition. In the block, this asset will be having zero value because you have already claimed. Asset transferred from scientific research or specified business, the value will be nil. And when you sell it, the block value reduces. When you sell it, the block. So two options, directly sell. Whatever you receive is your business income. Transfer it to the block and sell. Transfer it to the block and sell. Whatever value you receive will be reduction in the sale consideration of the block. Reduction of sale consideration in the block. Post-research scenario, after the research process is over, assessee has the option of transferring the asset to the block or directly sell it. Where he transfers the asset, the value to be recorded is nil and the sale value will be reduced. Where the assessee directly sells without transferring it to the block, then the money realized will be taxable in business income, where the money realized is over and above the original cost. That excess alone is capital gain. If 1 lakh asset, you realized 1,20,000. That 20,000 is capital gain. Any contribution to an approved agency. What are all approved? National Lab, IIT, IIM, universities, scientific research association, institution, social research, statistical research, everything only 100% now. And even you can contribute to another company whose main object is research. It can even be contributed to another company whose main object is research. Go through the section once. Go through. Can you please mute it? Sorry, it's not in mute. Can you please mute it? No more scientific research is going to be a bigger question because till last year only this weighted deduction, but it will come. But not a very great question and all. We can easily answer that question now. I'm in question number 9. The following are the details of Orchid India Limited engaged in the manufacture of pharmaceutical products. Sales, manufacturing expenses, administrative expenses, selling and marketing expenses, finance expenses. Charges paid for acquiring know-how. It is an intangible asset. Know-how is an intangible asset. We know depreciation is 25%. Charges paid for acquiring plant and machinery. 15% in May 20, December 20. Research and development expenditure, research equipment acquired, remuneration, expenses, contribution to an institution. The company has an opening WDV of 40 lakhs. The company has spent 22 lakhs for construction of a research lab which is not yet completed. Compute the taxable income of the company. Interesting question. Please read through. Let's go step by step. Let's go step by step. We will first do the working note for depreciation. Working note for depreciation. We all remember it is a manufacturing company. Why I am writing this is additional depreciation has to be claimed. The question starts with Arcade India Limited is a company engaged in manufacturing of pharmaceutical products. So it's a manufacturing company. Additional depreciation has to be claimed. Plant and machinery, that is 15%. Intangibles, that is 25%. Opening WDV for plant and machinery, the question says that the opening WDV is 40 lakhs. Additions put to use for 180 days or more. Put to use for 180 days or more. It is put to use for 180 days or more, 35 lakhs. Here it is 25 lakhs. That's why they have given the date. 10/4/20. They have given the date. Put to use for less than 180 days. Put to use for less than 180 days, 65 lakhs. Deletions or nothing. Balance available for depreciation. Balance available for depreciation. Less depreciation. Normal is, we all know 65 lakhs into 7.5% plus 1 crore 40 lakhs minus 65 lakhs into 15%. 65 lakhs into 7.5% plus 75 lakhs, that is 140 minus 65 into 15%. Into 15%. Here it is directly 25% because it is more than 180. Additional, okay, 35 lakhs into 20% plus 65 lakhs into 10%. Only for plant and machinery. Closing WDV. Our answer is always the depreciation part. Our answer is always the depreciation part. total depreciation. Total depreciation is 1612 plus 1350 plus 625. 35 lakh 87,500. 35 lakh 87,500. 35 lakh 87,500. I have always told you one way you can elevate the answer for the asset used for less than 180 days, the balance 10% of additional depreciation can be claimed in financial year 21-22. If you write this note, the examiner will understand that you have understood the law very well. Okay. Okay, he will understand that you have understood the law very well, provided he also knows the law. We don't know who is going to correct it. Okay. Working note 2. Scientific research expenditure. Scientific research expenditure. Research equipment. Research equipment. I'm writing it in absolute values, 60 lakhs. 60 lakhs. Remuneration to scientists, 10 lakhs. R&D expenses, 30 lakhs. Contribution to an approved research institution. Contribution to an approved research institution, 10 lakhs. And remember, construction of lab. Construction of lab. Construction of lab. Okay, whatever has been constructed. Okay. In scientific, in section 35, expenses can be claimed if it is approved. It need not be put to use. Approved expenditure, nowhere put to use. Put to use is only for claim of depreciation. Here, I need to get the approval of the ministry. I should present the project and get it approved. Once approved, even if it is not put to use, you can claim. Even if it is not put to use, okay, you can claim. Total scientific research expenses. Total scientific research expenses is 1 crore 32 lakhs. Even if it is not approved, you can claim. Last year, you had been claiming 150% of this expenditure except lab building. Okay, everything is now simple. It is only 100%. You just need to add it up. Last year, 150% was claimed on these things. Sales. The question says 500 lakhs less allowable expenses. Administration expenses 50 lakhs. Manufacturing expenses 1 crore. Selling and marketing 75 lakhs, finance cost 23 lakhs, depreciation we all has computed and kept it ready, scientific research expenses, scientific research expenses. So the total of expenses comes to this much, business income. Take your time, understand it. From this year, no big twist or turns in scientific research expenses. Land don't allow, otherwise 100% allow. Okay. Past 3 years expenditure can be accumulated and claimed if this is the first year. So this leads me to go to the next section, which is the most important section, okay, on questionable area, examination wise, everywhere. Okay, before that, let me also tell you, okay, then and there I'm putting some things in your mind. Don't feel that I'm loading you, just put it in your mind somewhere. If the company is opting for optional tax regime, no, they cannot claim scientific research expenses. 115 BAA, 115 BAB. They cannot claim scientific research. They cannot claim additional depreciation. Okay, so keep it somewhere stored. Don't even now worry about it. Okay, so this is the expenditure. These are all the things. Okay. Next major is 35 AD specified business. Should I remember all the specified business? My answer is no. My answer is no, you need not remember all the specified businesses. I'm writing and giving you no is my answer. You need not remember all specified business. The examination will use the word 35 AD or specified business. They are not asking you to remember 18 specified businesses. Okay. So don't worry about remembering the specified business. They will use the section number as 35 AD somewhere in the question, or use the word specified business. They are more worried about your understanding, not your memory. But generally, cross-country natural gas pipeline, hotels of 3-star categories, 2-star above categories, hospitals with 100 patient beds, storage of agricultural produce, fertilizer, sugar, honey, okay, infrastructure facility including housing facility, okay, manufacture of wafers, like that. These are some of the examples I am giving you. Some of the examples I am giving you. I want you to listen, that's all. These are some of the examples which I am giving you. Just listen. Okay, 1 minute. Okay, these are some of the examples which I am giving you. Listen. The law says, if you invest in this sector, you get deduction. If you invest in this sector, so the law is more concerned about you going and investing in this sector, not about the profit. And investment, scientific research is investment based, not about the outcome of the research. If you do research, I am ready to give. Similarly, if you invest in this sector, I will give you whatever investment. So we call it as investment linked incentive. If you invest in this sector, I will give you the deduction. Whatever you invest. The same principle, not even number of years said. If you started investing, later only you started the operation, past period expenditure can be past period expenditure. There is no number of years. All past expenditure can be accumulated and claimed in the first year of operation. All past expenditure can be accumulated and claimed in the first year of operation. No question of land, always. No question of goodwill, already the finance ministry itself said. No question of financial instruments, investment in shares, debentures, that is nothing to do with the business. I know, the lawmakers know that what they are giving is a huge expenditure. Construction of hotel, construction of warehouse, cross-country natural pipelines, fertilizer manufacturing. So the lawmakers said, if there is a loss from specified business, carry forward it and adjust it only against specified business, because obviously loss will come to you. So carry forward it and adjust it with another specified business. Or carry forward and adjust it with specified business income. But I know it will not, 8 years is not sufficient. Indefinite period of carry forward. I am not even going to the material, because ground rules I will make something clear. Not only in this section, in various places, especially section 80I, 80IAC, many places, the law is going to use new business. The law is going to use a term called new business. I want the clause to be clear. What is new business? Two conditions are mentioned in law as to what is new business. All of us, two conditions are mentioned in law as to what is new business. Not formed by splitting up of an existing business. That is, it is not a demerged unit. It is not formed by splitting up of an existing business. That is the first criteria. Use only new plant and machinery. 20% can be second hand. Okay? So I can interpret this 80% of plant and machinery should be new. Okay, should be new. Having said this, this is not for additional depreciation. This section 80 IAC and all will tell this. Imported second-hand machinery on which depreciation is not claimed under Indian income tax law will be considered as new. Please understand, imported second-hand machinery on which depreciation is not claimed under income tax law of India, for our country it is known as new. Don't categorize it as second-hand machinery. So once more, all of you, please, what is new business? If I wake you up at midnight and ask you also, what is new business? Till your examination, please remember this. Not formed by splitting up of an existing business. 80% of the plant and machinery should be new, not second-hand. However, imported plant and machinery, even though it is second-hand, if you have not claimed the income tax depreciation, then it will become new. Everywhere. I need not, henceforth, I will not say. I will say it should be a new business. Your mind should tell you it should not be formed by splitting up of an existing undertaking. Use 80% new plant and machinery. Imported machinery on which depreciation is not allowed under Indian law so far will be considered new. This is one thing which I want to tell you. Second thing which I want to tell you, which I will repeat in 2 or 3 places. Section 35 AD, the one which we are studying. Section 10 AA, the one which is about export profit, okay, which I was giving you a brief when we were doing international taxation, which we will see later. Section 80I are all speaking about sometimes the same thing. I am making it clear to the class. Infrastructure 80I is also there, 35 AD is also there. Unit in a SEZ 35 AD can also be claimed, 10 AA exemption can also be claimed. So be more clear, this is an expenditure. It is coming under PGBP. This is an exemption and this is a deduction. Okay, so assessee can claim only one benefit. Only one benefit. So all the 3 sections will have wordings like this. All the 3 sections. For example, 35 AD wordings will be where expenditure is claimed under this section, assessee is not eligible to claim exemption and deduction. Where expenditure is claimed under this section, assessee is not eligible to get exemption or deduction. Where an expenditure is claimed under one section, the other 2 gates close. Similarly, where an exemption is claimed, you cannot claim 35 AD and 80I. Where a deduction, so every section will have this. Okay, where deduction is claimed under this section, assessee is not eligible to claim expenditure under 35 AD or exemption under 10 AA. Okay. So even before going into the material, I want to make some things clear to you. What is new business is constant across the board. What can be claimed is constant in all the 3 sections. You need not remember what is specified business, they themselves will give you. Okay, with all these things we will go into and understand what is this specified business is all about. Okay, we'll come to social welfare later. In investment linked incentive. So if you invest, you will get it. Cold chain, warehousing, cross-country natural gas pipeline, new hotel, new hospital, housing projects, affordable housing projects. These are there in 80 IAB also. These are there in 80 IAB also. Fertilizer, uh, inland container depot, honey and bee waxing, storage of sugar, pipeline for transportation of iron ore, wafer products, and infrastructure facilities. Okay, we all know. It should be a new business. I need not tell you, but I am telling you, business should not be formed by splitting up or reconstruction. 20% of the plant and machinery can be old. Otherwise, it should be a new plant and machinery. Imported second-hand machinery on which depreciation is not claimed will be considered as new. Somebody who is very honest needs to be certified. Okay, right? What can be claimed as deduction? What can be claimed as deduction? 100% of the capital expenditure can be claimed as deduction. What if the business has not yet commenced? The same will be accumulated and claimed. However, no deduction for land, goodwill, financial instruments. 10,000 unapproved condition is back. Deduction is not available for any expenditure on a single day to a particular person. If you pay more than 10,000, otherwise than by approved modes, I will not give you. The consequences of claiming 35 AD is you will not be eligible for exemption or deduction. Depreciation cannot be claimed on such asset. When the asset itself is claimed as deduction, same for scientific research. Loss from specified business can be set off only against profit from specified business, and inter-unit transfer is only at market value. I'll tell you about that inter-unit transfer. Now, this section is now optional and not mandatory because of 115BA. If the assessee wants to claim 35 AD, he can, otherwise he can forego. Please read through quickly, not very difficult, but very interesting to understand. Questionable area. Don't think this is difficult. Okay? You can, by understanding so much, you can write so much in the paper. This is what new means. This you can claim only one benefit. Okay? And once you claim, you cannot claim depreciation. Loss can be carried forward and set off only against other business, like that. Keep reading it. Keep reading it. I am going to, sorry, we are going to work out 3 questions. These 3 questions will give you the whole idea of 35 AD. You will understand the section upside down in this 3 questions, so that you are categorically clear. Okay? Question 1. India Hotels Limited is involved in running and maintenance of hotels. Company started a 3-star hotel at Ayodhya, incurred 300 lakhs, cost of land, building, equipment, special care zone, goodwill, financial instrument in 1920. During the previous year 2021, it incurred 65 lakhs. Compute the amount of deduction under 35 AD. Second, if the company has loss from business, how the same should be treated. Third, if the company has another hotel in Kanchipuram which has earned a profit of 50 lakhs, what change will your working undergo? Fourth, suppose if the hotel is let out on a franchisee model to another person and India Hotel Limited only receives a royalty or rent, how will the provisions of the Act apply? Expenses incurred in financial year 1920. Expenses incurred in financial year 1920. The company incurred capital expenditure, cost of land. Please write it and put nil. Okay? Not to be claimed. Okay? Please write it. The examiner should not think you missed that line. The examiner should think that you know the provision. Cost of land, building, 75 lakhs. Equipment, 90 lakhs. Special care zone, 30 lakhs. Goodwill, not to be claimed. Financial instruments, not to be claimed. These can be accumulated and claimed in the FY 2021 when business commences. Cost of construction 65. Total expenditure under 35 AD is 2 crores 60 lakhs. 2 crores 60 lakhs. This can be claimed in the first year of operation, that is financial year 2021. This can be claimed in the first year of operation, that is financial year 2021. If the company has loss, how the same should be treated? Where there is loss in specified business, such loss needs to be carried forward and set off only against the income from specified business. Whatever is the loss needs to be carried forward and set off only against income from specified business. Such loss needs to be carried forward and set off only against income from specified business. Loss will be carried forward for an indefinite period. Okay, what is the period of carry forward? Loss will be carried forward for an indefinite period. If there is no restriction, it will be carried forward for an indefinite period. Loss will be carried forward for an indefinite. There is no restriction. This is the best part. I want the class to understand. I want the class to listen and understand this next two parts. Okay, very important. If the company has a hotel in Kanchipuram which has earned 50 lakhs, what change will your working undergo? Please understand that Kanchipuram hotel is not a specified business. But we are clear, loss from specified business can be carried forward and set off only against income from specified business. Here comes the point which I skipped because I want you to understand along with a nice example. Clarification issued by CBDT specifies that loss can be set off against the profit of another specified business irrespective of whether the latter is eligible for deduction under 35 AD or not. Sir, this Kanchipuram hotel was started before the section came into. This Kanchipuram, that is also a hotel. Is it a specified business? Yes. Is it eligible under 35 AD? No. Is it a specified business? Yes. But it is not eligible under 35 AD because at that time 35 AD was not there. So, it is a hotel. I am not setting it off against manufacture of iron and steel. I am not setting it off against my software business. I am not setting it off against my agricultural business. I am setting it off against another business of same nature, but which is not qualifying under 35 AD due to other reasons. The law says, yes, you can. Can the loss be set off against a same business which does not qualify under 35 AD? And the loss be qualified. This is also a hotel. In Kanchipuram also it is a hotel. Ayodhya also it is a hotel. In Kanchipuram also it is a hotel. Difference? Ayodhya hotel is falling under 35 AD, whereas Kanchipuram hotel is not falling under 35 AD, but it is the same business. Due to some reason, started before less than 2-star category. Due to some reason, it is not. CBDT has said claim it. Okay, CBDT has clarified that loss from a specified business can be set off against another same business which does not qualify to be a specified business due to other factors. CBDT has clarified, boss. Yes, I understand. You claim it. Okay, you claim it. Actually, it is okay. You claim it. CBDT has certified. I understand. You claim it. This is also a specified word. By some means, it has not been coming under 35 AD. So this benefit is now a bigger benefit. Now a bigger benefit. Because many hotels, many hospitals might have started already and making good profits. Now they are starting a new, which will qualify under 35 AD. but they can now set off the profits, which is a real good thing CBDT has done. Remember this point. Suppose if the hotel is let out on a franchisee model to another hotel, and India Hotel Limited only receives royalty and rent, will the provision still be applicable? I want you to understand why this question came into in the first place. The provisions of the law says, okay, building and operating a new hotel. I built, you operate. Can I claim? I built a new hotel. I am not operating. All these properties are operated by Welcome Group or Marriott Group of hotels, GRT Group of hotels, because that is, they are professionals. But I have the property. I built the hotel, you operate the hotel and you pay me royalty or rent. Can I claim that deduction? Repeating. I built the hotel, you operate the hotel. The law says building and operation. Should building and operation be by the same person to claim 35 AD, or expenditure 35 AD might be incurred by one person, another person is operating it. The Supreme Court has clarified in the same case, India Hotels case. The Supreme Court has clarified building and operating. The word and also includes are. The intention is promoting this business. Have you incurred the expenditure? Yes. Is it a specified business? Yes. Are you continuing? Is the operator continuing to operate it as hotel? Yes. Claim it. Claim it. Building and operating need not be by the same person. It can be by two different persons, but it should be operated as a hotel. You cannot construct an assembly building, convert it into hospital. Okay? If you construct it as a hospital, run at a hospital, then fine. Construct it as a hotel, running as a hotel by some other person, no problem. Okay? And building and operation be by different persons. In India Hotels case, it was held that deduction will not be denied just because it is operated by some other person. Only condition is that it should be continue to be operated as a hotel or hospital. Okay, all the four are important questions here. I hope you are all understanding it in its fullest dimension. Mr. A commenced the operation of the business of setting up warehousing facility for food grain, which is covered under 35 AD, sugar, which is covered under 35 AD, and edible oil, which is a general business. All these things on 1/8/2020. So edible oil is not a specified business. Sugar and food grains, agricultural produce, are specified business. He incurred capital expenditure of 80, 60, 50 on purchase of land and building between 1920, in the financial year 1920, exclusively for the above business, and capitalized the same. The cost of land are 50, 40, 30. So building will be 30, 20, 20. 30, 20, 20 building. Land will be 50, 40, 30 out of this. This is totally for land and building. On that land part is 50, 40, 30. So building part is 30, 20, 20. 30, 20, 20. Further, during the current year, incurred capital expenditure of 20, 15 and 10 for the extension of the building. Compute the income under PGBP and the loss to be carried forward, assuming that A has fulfilled all the conditions of 35 AD and not claimed any deduction under section 6A. Okay, chapter 6A. The profits of the business of setting up warehousing before claiming depreciation or deduction is 16, 14 and 31 lakhs respectively. Read through. First two are specified business, next is not. Expenditure incurred in 1920 is 80, 60, 50. 80 lakhs, 60 lakhs, 50 lakhs. Less cost of land which is not allowed. Okay, 50, 40, 30, 50 lakhs, 40 lakhs, 30 lakhs. So, cost of building will be, okay, 80 minus 50, 30 lakhs, 2020. Additional building cost, that is construction cost, in 2021. Additional construction cost in 2021, 20 lakhs, 15 lakhs for capital expenditure for extension or reconstruction of the building purchased. 20, 15, 10. 20 lakhs, 15 lakhs, 10 lakhs. Total building cost 30 plus 20, 50 lakhs. Okay, in sugar 35 lakhs, in edible, okay, fully claimed. Depreciation at 10%. It's a building, so depreciation. So here these two things can be fully claimed. Here it is not a specified business, only depreciation they can claim at the rate of 10%, 3 lakhs. Only this year the business commences, so you cannot claim in the last year the depreciation. Why I have not claimed on last year building is that only when it is put to use 1/8/2020, 1st August 2020, only the business has commenced. So I will put to use only from 1st August 2020. That's why this year I am claiming the entire 10%. Entire 10%. So in the case of food grain and sugar, land cost cannot be claimed. whereas building cost of the past year and current year can be claimed. Edible oil, keep capitalizing the building cost, and in the year in which you commence the operation, claim the depreciation. Claim the depreciation. Computation of income. Computation of income. Income before claiming 35 AD or 32. Income before claiming 35 AD or 32, 16 lakhs, 14 lakhs, 31 lakhs. Less expenditure under 35 AD is 50 lakhs, 35 lakhs. Less depreciation under 32, 3 lakhs. Loss from specified business, which can only be carried forward and cannot be set off. Loss from specified business, which can only be carried forward and cannot be set off against our edible business. Profit from edible oil, okay, it's a non-specified business, so this profit will be taxable separately. This profit will be taxable separately. This loss will be carried forward separately. This profit will be taxed separately. This is one other stunning question in 35 AD. If we complete all these three questions, I am very confident that any question in 35 AD, later I will do it in assessment of firm or company also, but at that time that will look child's play for you because you will become thorough with these three questions. On September 1st, 2020, X Limited commences the warehousing operation in Andhra Pradesh for storage of warehouse agriculture products. The following are the expenses. Expenses before 19, land, construction cost, purchase of know-how, salary of staff. The expenses in the current year, construction, old plant and machinery from domestic market, 2 lakhs. Old plant and machinery imported, 4 lakhs. New plant and machinery, goodwill. P&L on the credit side, warehouse. Debit side, depreciation of building, machinery, know-how. Other operating expenses, donation to political party and net profit. Out of other operating expenses, 40,000 is made in cash. Find out the taxable income of the company on the assumption that X Limited has the following other sources of income: commission income and dividend from foreign company. Read through. Working note for testing the new plant and machinery condition. Working note for testing the new plant and machinery condition. Purchase of old machinery from domestic market. It is coming to 2 lakhs. 2 lakhs. Purchase of old machinery from Germany. So import of old machinery, okay, from Germany, 4 lakhs. 4 lakhs. Purchase of new plant and machinery, 9 lakhs. Total value of plant and machinery, total value of plant and machinery, my dear friends, total value of plant and machinery, 15 lakhs. 20% can be second hand. Okay, 20% can be second hand into 20%. 3 lakhs can be second hand. What is considered as second hand is only this 2 lakhs. What is considered as second hand is only this 2 lakhs. This imported machinery, okay, imported machinery, okay, assuming depreciation is not claimed under IT law of India, is a new plant and machinery. So this 20% condition is fulfilled. 20% condition is fulfilled. Why? Because up to 3 lakhs you can have second hand machinery. You have only 2 lakhs. No problem. No problem. I will not consider that 4 lakhs Germany imported machine itself. Sir, what if it has exceeded 3 lakhs? 35 AD is not applicable. You go by normal provision. For your understanding, I am saying, if it has exceeded, then it is not a new machinery. Okay, so you cannot claim at all. Working note for expenditure under 35 AD. Working note for expenditure under 35 AD, okay, starting from before 2021. Purchase of land, I cannot claim, it is not allowed. Purchase of land, okay, not allowed, cannot be claimed, so you cannot. Okay, construction of warehouse, 8 lakhs. 8 lakhs. Know-how, 10 lakhs. 10 lakhs. Salary to staff, 78,000. Expenses in 2021. Expenses in 2021. Construction cost, another 60 lakhs. Construction cost another 60 lakhs. Plant and machinery, we have the total itself. Why to waste time? We have the total itself, it is 15 lakhs. Plant and machinery 15 lakhs. Goodwill you cannot claim. So 93 lakh 78,000. 93 lakh 78,000. Till last year, I was claiming depreciation on goodwill. Now that cannot be claimed. The amendment is from 1/4/2020. So goodwill cannot be claimed. Okay. Depreciation on goodwill also cannot be claimed. Depreciation on goodwill also you cannot claim it. So it is 93 lakh 78,000. Net profit as per P&L account is 3 lakh 49,000, and what is how we popularly call it as inadmissible expenses. And inadmissible expenses, depreciation on building, because you are claiming the building itself as a deduction. Where the asset is claimed as deduction, depreciation cannot be claimed. 3,40,000 depreciation on plant and machinery. Okay, where plant and machinery is claimed as deduction, you cannot claim cost of know-how. I'm anyhow writing it off there. In our 35 AD. So I cannot claim. Section 40A3, cash payment disallowance. Those who know it very much, please. Otherwise, we'll come to that in the later part of the class. Okay, 40A3 disallowance. That is, if you are paying by cash, the same is disallowed, 40,000. Cash disallowance 40,000. Okay, donation to political party, which is also not allowed, 10,000. Net profit before claiming 35 AD. Net profit before claiming 35 AD is 70 lakh 89,000. Less expenditure under 35 AD. Less expenditure under 35 AD. We all have worked out and kept it. Okay. Loss from specified business, which needs to be carried forward and set off against income from specified business. Loss from specified business which needs to be carried forward and set off against the income from specified business. Income from other sources. The question is not yet over. Income from other sources. Commission income. The question says that they have earned a commission income of 20 lakh 15,000 after claiming everything. Dividend from foreign company, okay, is 50,000. You cannot use this for setting out off because you can only carry forward that loss. Gross total income is 20 lakh 65,000. Gross total income is 20 lakh 65. You cannot use that loss to be set it off. It is GTI. Deduction under section 80 GGB. Recollect, this political donation will have a deduction under 80 GGB. Recollect. Okay. So that my total income is 20 lakh 55,000. One of the finest, lengthiest question we have answered, understanding lot of things. Patiently look into. Don't get lost. Don't get worried. These are understandings only. We did test the missionary part condition. We are convinced that we got the condition fulfilled. We understood that the total expenditure under 35 AD can be 9378. We understood this and we computed the total income. Loss from specified business, you cannot do anything. It needs to be carried forward. So, the bottom line of 35 AD is all capital. In examination, standalone question, if it comes, answer. Otherwise, it's a very simple question. They'll give you the one cost, saying that this is the total 35 AD cost along with land cost. So you will remove land cost and just working out some questions so that you are getting some additional inputs, getting confidence, and it should not shake your confidence at all. If you are okay, it's a very simple, straightforward understanding. So don't worry. Okay, this is the way in which 35 AD is being worked out. This is the way in 35 AD. Again, we will work out once in assessment of companies or somewhere and then make ourselves more clear. Once we continue. So, uh, actually, the most important part of PGBP chapter is over. Actually, this is 32 and 35 AD, if you are able to understand, which is 35 scientific research, it's a nice thing. Okay. Now, when I started section 35, I said one of the case laws in 35 AD, later we will see, is the Seabros case law, where the question was, where the issue involved was, assessee started incurring the expenditure, then only got the approval. Once more, assessee started incurring the expenditure, then only got the approval. Can the assessee claim? The answer is yes. The court held intention is the supreme. Is he in the specified business? Has he incurred expenditure for specified business? Allow him, because the intention of investment is proved and approval is only a formality, substance over form. So approval is only a formality. Section 35 has 4 aspects. Scientific research, specified business, 2 of the most important. Social welfare and amortization. Social welfare is very small. This time again, because of all weighted deductions going off, all the more becomes simple. Eligible projects. Okay, that is, they will use this word. Schools, colleges, dams, any contribution or a direct spending by the company on eligible projects is allowed. Payment to association and institution which is carrying on rural development programs allowed. Okay. These 2 are sometimes being questioned. Those 2 are rare. Notified agricultural extension program till last year 150%, now 100%. No question of cost of land anywhere. No weighted deduction. Sorry for using that word. Okay. It is not going to be a weighted deduction. It is just deduction. Notified skill development program. 100% of the expenditure will be allowed, no deduction for land and building. 100% of the expenditure will be allowed and there is no question of deduction for land and building. So section 35, social welfare deductions are 4. Eligible projects, rural development, I have not seen question, agricultural extension program, and notified skill development program only for manufacturing companies. This is okay. 100% will be allowed. Nowhere land will be allowed. In skill development, even building will not be allowed. In skill development programs, even building will not be allowed. Amortization. What is amortization? Amortization means writing off an expenditure in multiple installments. Amortization means writing off an expenditure in multiple installments. The benefit is spread over both in section 35 and 36. In income tax law, there are 7 amortization. in accountancy, we call it as deferred revenue expenditure. In income tax, 7 amortizations are there. 7 amortizations are there in income tax law. Okay, 7 amortization for 5-year period. Okay, what are all for 5-year period? Means preliminary expenses, amalgamation, demerger expenses, VRS compensation, voluntary retirement scheme compensation, capital expenditure on promotion of family planning amongst employees for companies. Only for companies. For companies. So, over 5 years, 4 things: preliminary expenses, amalgamation demerger expenses, voluntary retirement scheme compensation, and in the case of a company, if they have incurred any capital expenditure on promotion of family planning amongst employees, it is 5-year period. Okay, over the period of the asset. Okay, it is not 5-year, over the period. Okay, telecommunication license, if they grant the license for 10 years, whatever license fees you have paid, claim it over 10 years. Spectrum fee and discount on zero coupon or deep discount bonds. Okay, I issue a bond which is 100 rupees for 60 rupees. Deep discount. That 40 rupees discount, it is a 10-year bond. Totally 1 crore bonds are issued. 40 crores has to be claimed over 10 years. 4 crore every year. Okay, in fact, over the lifetime will be the better word. Over 5 years, preliminary expenses, amalgamation demerger expenses, VRS compensation, capital expenditure on promotion of family planning amongst employees. Over lifetime, telecommunication, spectrum fees, discount on zero coupon bonds. Totally there are 7 amortizations. Totally there are 7 amortizations. 4 over 5-year period. Preliminary, amalgamation demerger, VRS compensation, capital expenditure on promotion of family planning amongst employees. 3 over the lifetime, telecommunication, spectrum fees, discount on zero coupon bonds. Totally 7 amortizations. Here I want the class to be understanding one thing: VRS compensation. Remember, okay, only VRS compensation is amortized. Compensation on retrenchment of employee. You are closing down an unit and sending out employee. Fully claimed in the year of incurrence. Okay, you will claim it fully in the year of incurrence. There is no amortization. There is no amortization. VRS compensation only amortized. Retrenchment compensation, closing down an unit, sending out an employee, paying him lump sum will not be amortized. It can be claimed immediately. It can be claimed immediately. Telecommunication license can be claimed on payment basis. Okay, can be claimed on payment basis over the balance period of license. Okay, if the license is sold, adjust it and claim the balance, or 41 will apply where you sell it more than the cost. Spectrum fees, same like telecommunication. Preliminary expenses, 5 years. The expenses should not exceed 5% of cost of project or capital employed, rarely. Amalgamation demerger expenses, 5 years. VRS compensation, 5 years. Okay, VRS expenditure including VRS compensation. Okay, remember it is only for VRS. A quick read through, please. A quick read through. Okay, okay, okay. So we have the following things in section 35: scientific research, specified business, amortization, and social welfare. In our travel, we completed income, asset-based deduction, deposit-based, and 35. 36 and 37 are twinning sections. 36 is to do with other deduction, a list of deduction. 37 does not have a list but only conditions attached to it. So let's travel to 36 and 37. 36. Following are the expenditure which are allowed as deduction: insurance premium on stock, livestock, and group insurance. These are logical, no question of any big things. You need not remember the list and all. Logical. Insurance premium. It's not a capital expenditure. Bonus or commission. Interest on borrowed capital, provided the same is used for the purpose of business. That is, the borrower should be used for the purpose of business. Interest, claim it. Interest or discount on zero coupon bonds. Just now I told you. Just now I told you about the methodology of computing this. Okay, right. Employer's contribution to recognized provident fund, superannuation fund. Employer's contribution. Okay. Employer's contribution to gratuity fund. Remember, this is actual contribution. This LIC and all we contribute, no? That is employer's contribution to gratuity fund. Employer's contribution towards staff welfare schemes which are approved staff welfare schemes. Employer's contribution to pension fund to the extent of 10% of salary. To the extent of 10% of salary. Bad debts. If it is livestock, bad debts is write-off. write-off of animals. This is basically for that Amul, Gujarat Milk Cooperative Federation. Sorry, domestic banks. Okay, and cooperative societies. Provision for bad debts is 8.5% of total income plus 10% of rural advance. 8.5% of total income plus 10% of rural advance. For foreign banks and financial institutions, only 5% of total income. There is nothing called rural advance, and the rate is 5% of total income. STT, CTT will be allowed if it is held in stock. Quickly read through. Employer contribution, RPF, superannuation, gratuity fund, pension fund to the extent of 10% of basic pay plus DA forming part. Approved staff welfare. 50% of our 36 speaks about this only. All these things are subject to 43B. It should be paid within due date. We'll come to that section. It should be paid within due date of filing returns. Otherwise, this will be disallowed. All these things are subject to 43. 50% of our 36 speaks about this only. Bad debts, write-off of animals. Provision for bad debts, not for all. Can a company or a software giant, etc., they can claim? No. They can claim bad debts, not this, only for banking and financial institutions. Domestic, 8.5% of total income plus. We know that the possibility of rural advance is less, 10% of rural advance. Foreign bank and FI, financial institution, 5% of total income. 75%, 80% of our 36 is this. You can stand upside down also, more than this you cannot read. Okay, other than this, STT, CTT, insurance, bonus and commission. In fact, I can include that in section 36 here itself, bonus and commission, because that is also coming under 43B. So this is what 36. Don't give so much of importance to 36. I told you 31, 32 should be clubbed. 30, 31. Am I audible? Am I audible, friends? Am I audible? Sir. Because suddenly it came, you are muted. That's why I'm asking. Am I audible, right?
Yes, sir.
Yeah, thank you. So, 36 is just a list. I told you 30, 31 and all, club it with 36. Because those are plant and machinery, building, you can write it as one more point, nothing wrong. Okay. So, Don't worry about it. The last point we have already seen. Family planning expenditure only for companies. Revenue expenditure fully allowed and capital expenditure allowed in 5 equal installments. This is what section 36. It's a one-page section. It's a one-page section. 37 is half a page. Expenses, which is not capital, which is not personal, which is incurred wholly for business in the previous year is allowed. Once more, those expenses which are not covered under 30 to 36. Those expenses which are not covered under 30 to 36, which is not capital, which is not personal, which is incurred during the previous year. Here is where we understand prior period expenses are not allowed. Because expenses should be incurred in the previous year. Prior period expenses, the law says you refile the return, revise the return. Not in all cases, some cases they will allow generally. And the expenses should be wholly and exclusively, you all know the significance of this word, wholly and exclusively. Expenditure, which is not capital, which is not personal, which is not covered under 30 to 36, which has been incurred during the previous year for the purpose of business or profession, allowed. That's all section 36. 37. That's all section 37. Expenses, which is not covered under 30 to 36, which is not of capital nature, which is not of personal nature, incurred during the previous year for the purpose of business or profession is allowed. If it is capital, disallowed. If it is personal, disallowed. If it is prior period expenses, disallowed. If it is not wholly and exclusively for business, to that extent which is business will only be allowed. Penalties are disallowed, whereas interest is allowed. Penalties is not violation of law. I'm sorry, interest is not violation of law. It is late complying with the law. Whereas penalty is violation of law. Once more, interest is late complying with the law, allowed. Whereas penalty is violation of law, not allowed. CSR expenditures are not allowed. CSR expenditures are not allowed. Okay. Quick read of 36 and 37 before going into the case laws. Yeah, license fees on the basis of payment, Abhi, I have written there. Yeah. right? Let us go and complete the small case laws of section 37. Oriental Ceramics Limited, where the law held close sign boards are revenue expenditures only. It is not a capital expenditure. It will take a small stone to put it down. So it is as revenue expenditure only. ITC Limited. My dear friends, I was just telling you zero coupon bonds should be amortized. Deep discount. What about issue expenses of debentures? You can claim it. Issue expenses of shares, you cannot claim it preliminary expenses. Whereas issue expenditure of debentures, you can claim it. Nowhere the law says it should be amortized. Nowhere when the specific provisions are not available, amortization, hence it is allowed. It is a proper revenue expenditure. It is allowed. Via Village Roadshow, repeated case law. You have incurred an expenditure on study, feasibility study. PVR theatres, they incurred expenditure on this speakers, new sound systems, but then dropped it because they felt that it is not the right sound system. Had the sound system been created, it would have been capitalized with the cost of the asset. They dropped it. When an asset is not created, where the expenditure incurred has not resulted in creation of an asset, then such expenditure shall be written off. It cannot be treated as a capital expenditure. Doctors are not supposed to take referral fee. Doctors are not supposed to take any freebies, etc. Okay? CII of pharmaceutical sector, Confederation of Indian Pharmaceutical Sector. If the pharmacy company give freebies to a doctor, samples to a doctor, it will not be allowed because it is not ethical. It is not ethical. A doctor should not get these things. A chartered accountant should not get gift from clients. Okay? Capscon Diagnostic Center, they paid referral fee to the doctor. Not allowed. Not allowed. Violation of ethics. Okay? XJ Forgings. What happened is, director's son, sorry, confused doctor. Director's son was sponsored by the company for higher studies. Is it wrong? Not wrong. If the company already has a scheme and one of the beneficiaries is director's son, if the company where the organization has such a scheme and one of the beneficiaries is director's son, nothing wrong. But if you are the only beneficiary or first beneficiary also, you are creating now a scheme, it should be already there, accepted. If you are the only beneficiary or the first beneficiary, it will not be allowed. It will not be allowed. Shati Bhushan, waste of time. Okay. Neelavati. Sometimes you make an illegal payment for your business purpose. Many hotels which are there, they are on the main road. The parking is regulated by the local police personnel for proper parking. Many places you can see. So this hotel pays that police personnel. Is it allowed? No, it is an illegal payment. Payment made to police personnel and gundas to keep away various. Any such payment is in violation of general practice. It is an unethical payment which will not be allowed. Any unethical payment will not be allowed. So is the case of Millennia Developers. I constructed 4 floors where I have only permission for 3 floors. I constructed 4 floors, whereas I have permission only to construct 3 floors. 4th floor, I paid regularization fee. The law said it is like a penalty. It is like a penalty. Regularization fee is in the nature of penalty. So I will not allow it. I will not allow it. I get know-how from you. Is it a capital expenditure or revenue? Capital. I get license from you. Is it capital or revenue? Capital. But the agreement between you and me says has a termination clause. Anytime you want, with this notice you will terminate or I will terminate. Does that mean it is a revenue? Just because termination clause is there, still the expenditure incurred is capital. Very, very important case law is this Honda Seal case law. Technical fees paid under a technical collaboration agreement for setting up of a joint venture company where there exists a special clause that the termination clause. Adanaala, is the expenditure revenue? No. Every agreement will have a termination clause. On termination, the know-how or other benefits transferred might also cease. But that does not mean that the cost incurred is of revenue nature. These are capital and assessee can claim only depreciation. In many questions, the adjustment will be license fees of 20 lakhs paid and it has been taken as intangible. You can claim only 25%. Though this is not a specific case law, but it is an interesting, this and the TVS Motors are not current case laws, but I have included for a specific purpose. TVS Motors case, replacement is not addition. In depreciation, you will find that case. Replacement is not addition. Replacement means existing asset is replaced. That is a revenue expenditure. When I say I can incur staff welfare expenditure, it can give direct or indirect benefit. Infosys erected a traffic signal for safe crossing of their employees. Signal is given to the government. It is an indirect benefit to the staff. By that such expenses are for the benefit of staff. Further, the asset is also not owned by the company. So it should be treated as, because the signal cannot be operated by the company. It can only be by the government. So these are all the case laws to remember. Priya Village Roadshow, remember, it's not difficult to remember. You read it once, twice, and we practice in the classroom, you will remember. You will remember these case laws. I have crossed up to this. I have crossed up to this. From 28 to 37, if you see, we have crossed the 9 sections plus 41. 10 sections are over out of the 16. 38, 39 are not there. So I can say 12 sections are over. What is TDS default? I am going into the disallowance provision. The first thing is what is meant by TDS default? Tax deduction at source default. What is TDS default? TDS has two conditions: deduct, remit. The payer has to comply with two conditions: deduct, remit. When should deduction be? Before 31st March. In the same year, deduct. When should remitted be? 1 month before the date of filing returns, on or before September 30th. Because due date of filing returns is 31st October, on or before 30th, prior 1 month prior to the due date of filing returns. Deduct in the same year, remit it on or before 30th September. Both fulfilled. No default, claim fully. Both or any one not fulfilled. Default, disallow 30% of expenditure if the receiver is resident, 100% of expenditure if the receiver is non-resident. Simple, straightforward, 5-6 lines provision. Any payment for non-resident, fees, technical service, royalties, salaries, any payment, they might have given it in 4 sections. This is the provision. This is the provision. %30% if the receiver is resident, disallowed if there is a default. What is a default? Either not deducted or not remitted within the specified time. Disallowance is 30% if the receiver is a resident, 100% if the receiver is a non-resident. Default rectified in future years. Whatever disallowed, allow it in that year. That is, that 30% whatever you have disallowed, allow it in that year in which the default is rectified. Allow it in that year in which the default is rectified. Okay? Okay? Right? Wherever you can see in the law, this is the provision. Because salaries, there will be a separate section. Non-resident salaries, non-resident payment 40A1, 40A2, 40A17. Everywhere, this is the provision. You remember this, this is enough. TDS default means from the payer's end, there can be two default. One, it is not deducted on or before 31st March in the same year, or it is not remitted 1 month prior to the due date of filing returns before 30th September. If you have not done, 30% or 100% of the expenditure will be disallowed. 30% if the receiver is a resident, 100% if the receiver is a non-resident, it is disallowed in your hands and allowed in the year. Whatever is disallowed is allowed in the year in which you rectify the mistake. You rectify the mistake. One extra benefit the law gives. This alone take a small time to understand. I am the payer. Our friend Preeti is the receiver. Some professional fee or something like that. I paid without deducting tax. For the financial year 2021, I paid without deducting tax. Realizing my mistake in 21-22, I want to deduct tax, but meanwhile Preeti comes and tells me, see, you have not deducted tax, okay, but I have declared that is income in my return and paid the tax. Now you again deducting is not going to benefit either me or you. She comes and tells me, look, this is the proof. I have declared it, whatever you gave, the money you gave, I have declared it as income and paid the tax. Now you saying that you will again deduct tax. But I am saying to Preeti, see, when will my default be rectified? Only if I deduct and remit, my default is rectified. To counter this problem, the law was amended where the receiver submits proof that the amount received is considered as income and due taxes are paid, then the default stands rectified. So the law is now saying, okay, you need not repeat it. Then the default stands rectified. Disallowed expenses can be allowed in the year of submission of proof. This is the most important thing to understand here. Financial year 2021, I paid to Preeti 5 lakhs without deducting tax at source. Preeti says, I have considered it as income. See, before July, I have filed my return. Here is the proof. Can I now claim that in 2021 itself? The answer is no. When did the default get rectified? When Preeti filed a return. When Preeti gives me the proof, what is the proof Preeti is giving me? Her return. When she has filed it, 21-22. So even though she has submitted the proof before my due date, in the first year it is disallowed. Disallowed expenses, only if you disallow, disallowed expenses will be allowed in the year in which, year for which, the year in which the proof has been submitted to me. The proof has been submitted to me. I accept. You need not again deduct, but first year you disallow, next year you claim. Tax has to be deducted in the same financial year in which expenses are incurred. Tax has to be remitted into the government account. If it is 100% of expenditure non-resident, 30% of expenditure resident. However, the disallowed amount will be allowed in the year in which the default is rectified, where tax has not been deducted, but the recipient provides proof of considering the same as income and paying taxes. Then the disallowed amount, so first you should have disallowed, will be allowed in the year in which the recipient gives the proof. This is what it is. Wherever it is the provision. It might be in 40A, 1A, 1B, 1C, 1D, anything. Don't worry about it. Equalization levy is also like TDS for a non-resident. Equalization levy itself is for a non-resident. So 100% disallowed if you are not deducted. 165, not 165A. 165A is for the recipient. 165 is for the payer. 100% disallowed if it is not deducted. If it is not deducted, 100% disallowed. Income tax. Income tax, provision for income tax, advance tax, interest payable under income tax, penalties are disallowed. Sir, interest you said allowed? Sir, In income tax, interest is not allowed. Interest on income tax. Interest on other taxes allowed. When income tax itself is not allowed, why will I ever allow interest on income tax? Okay, so these are allowed. Disallowed. Income tax, provision for income tax, advance tax, interest under income tax, penalties. Nothing is allowed. It is disallowed. Interest on loan taken for payment of income tax, disallowed. Even if you take a loan for payment of income tax and pay interest on that loan, it indirectly means interest on income tax. Even if you take a loan for payment of income tax and pay interest on such loan, it indirectly means you are paying interest on income tax, disallowed. Tax on perquisites for employees, disallowed. The income tax, because it is income tax, it is the nature of income tax. Any type of income tax will be disallowed. Any income tax will be disallowed. It cannot be allowed. One benefit which indirectly one case law gave, we are using that. However, 234E, sorry, 201 interest will be allowed. Okay, interest on late remittance of TDS. Now they have stopped questioning it, but still there is a case law which says if you remit TDS late, it is not your income tax. It is not your income tax. It is some other person's income tax which you are remitting. So it is allowed, is one of the popular judgments. I will give you that judgment over the period of class. Okay, but this is one of the things which the law allows. In some suggested answers, they have said that this is allowed. Okay, otherwise all types of income taxes are allowed or disallowed. Income tax, wealth tax disallowed, salary payable outside India, tax on perquisites, everything is coming under the same aspect. 40 tells about taxation only, TDS and income tax. Maybe several subsections, but it talks about TDS and income tax. TDS is also part of income. So it is only about talking about income tax. TDS default, one major section. All other types of income taxes will be disallowed. Okay. These disallowance provision, I will tell you what to remember for your examination purpose. From your examination eyes, I am looking at it. Of course, sometimes I do deviate. Okay, I also realize that 35 AD, the third question, probably I should not have taken up in our fast track material, because such questions doesn't come testing of plant and machinery, testing of, okay, and so many other things. Just when I was taking the break, I realized probably I should have avoided this in the fast track material. But no way, don't lose the confidence because of such things. I know by sheer experience, by God's grace, I know what are all these questionable areas. Their questionable areas are very restricted, not as you think it is wide. It is very restricted. 10 question papers you can see. It is very restricted to 80% of the questions are repetition. So never worry about it. Okay. So simplify and read. Okay. Make that. The problem is when you simplify and read, the problem is you will not believe that you know the provision. The biggest problem is you will not get satisfied. Oh no, it should be voluminous. Then only I will accept that I have studied. Not necessary. Simplify. Okay, you take the material of international taxation of our institute and check whether we have covered everything. You will be surprised. We have covered everything, but we have tried to simplify it. We have worked out sufficient number of questions also. Please have that confidence. That's what I want to again and again, because when especially a chapter like PGBP, when I simplify, I always have the fear that you will not feel that, come on, this is only PGBP. Yeah? What is he talking? You will have that feeling, but really this is only PGBP. If PGBP itself is so simplified, capital gains, I am going to capsulize and give it to you. This is what capital gains. And then prove you by working out exam questions also. Majority of the exam questions are incorporated in the material. Of course, I do take a small deviation wherever I feel that we can learn little extra. Okay, right. Now 48, payment to relatives. This is a popular question, but not very popular in terms of, not very difficult. In excess of fair market value is disallowed. If you remember this words, this section is over. Payment to relatives in excess of fair market value will be there. I buy goods from my subsidiary company. Can I buy? Yes, you can buy. But don't buy it here. When it is available in the market for 50 rupees per unit, if you pay 60 rupees for your subsidiary company, that means you are shifting profits. From your company, you are shifting profits. Why? EPS only you will take. Shifting profit to a non-resident only is mistake. Shifting profits to a resident is also trying to escape from the taxation. That's why, if you remember, day one of our class, I started not with the DP provision, with 48.2 only. Whatever is applicable for a non-resident which is not correct is also not correct to a resident assessee also. So any payment to a relative in excess of fair market value for goods and services shall be disallowed. In excess of fair market value will be disallowed. It will always include substantial interest holder, me also, who holds 20% of voting rights of a company. Except one place deemed dividend, in all other cases, substantial interest means 20%. Otherwise, individual, who is relative, we have been seeing from the gift angle, everything, firm, partners, companies, etc. Only the excess payment to be disallowed. These are expenditure which are claimed under 30 to 37. We are only speaking about what is the disallowed portion. We are only speaking about what is the disallowed portion. Payment in excess of rupees 10,000. Payment in excess of rupees 10,000. It should not be by unapproved modes. What is unapproved modes? What is unapproved modes? Cash, bearer check, cross the check. 3 unapproved modes. On a single day to a particular person, if you pay more than 10,000 by unapproved modes, whole of such payment is disallowed. What is disallowed? The whole of such payment, not the excess. the whole of such payment is disallowed. On a single day, to a particular person, if we pay more than 10,000 by unapproved modes, by cash, barrel check or cross check, whole of such payment will be disallowed. Make it by approved modes. What are approved modes? Account payee check, account payee draft, credit card, debit card, bank transaction, NEFT, RTGS, RuPay, VMAT. However, sometimes necessity forces. For a resident transport operator, lorry walas, because they have to on the way look after various expenditure and keep going. For them, if you pay the transfer, what will they do? So the limit becomes 35,000 for them instead of 10,000 for a resident transport operator. That's all, sir? No. Agriculturist, fisherman, employees outside the base location for 90 days. Suddenly they have to meet some expenditure there. Emergency payments will all be allowed. In all those cases, if there is a genuinity, allow it. Intention of the law is not to slash you. Intention is to make you comply with it. Okay? Okay? Thirty-one 2019 example, my dear friends. Listen. 31/3/2019 paid 40,000 by cash. Is allowed in okay, 31/3/20, sorry, 20. Disallowed in 1920. 31/3/20 purchased goods on credit, rupees 40,000. So in 1920, what entry you would have passed? Purchases to creditors. So allowed in 1920. 1/5/20 paid the money by cash. This is a unique problem. Expenditure is there in 1 year, violation is there in another year. Disallowed, no, we cannot say, because only if it is, what did I say? You should have claimed it under 30 to 37 to disallow it. I claimed the expenditure in 1920. In 2021, how you can disallow it? I claimed the expenditure in 1920. How can you disallow it in 2021 when the expenditure itself is not there? Yeah, right. But in 2021, there is a violation. You have paid it by cash. Expenditure has been accounted on mercantile basis. In that year, due but not paid, allowed. Current year, paid but violating, nothing to be disallowed. Only if the expenditure is there, I can disallow. There is no expenditure, where will I pay the money? By cash, where will I disallow? Law gives the simple solution, treat it as income. In the year of violation, treat it as income. If expenditure and payment are not in the same year, expenditure precedes payment, and expenditure is in some other year, income payment is in some other year, and the payment is in violation, treat it as income. Where assessee incurs expenditure in respect of which payment of aggregate exceeds 10,000, then the entire amount should be disallowed, not that the excess. In case assessee follows mercantile system of accounting, if expenditure is allowed as deduction on due basis in any of the preceding year, for which the payment is made by cash or bearer check or cross check, and such payment exceeds 10,000, then the amount paid shall be treated as income in the year of payment. Exceptions: all government payments, bank payments, agriculturist, etc. Salary paid temporarily outside the base location, all these things. Remember the popular things alone, that is enough. That is enough. Please go through it once more. They are taking out this from the next year. Emergency payments are not allowed from the next year. Any contingent provisions will not be allowed. Any contingent provisions will not be allowed. Actual payment is allowed. Payment contribution to gratuity fund is allowed, but provision for gratuity and payment to non-statutory funds are not allowed. Non-statutory funds are not allowed. I have cleared up to this. We have completed up to this. Because why we are able to complete 40A faster is not because the provisions are simpler, but it is an extension of 30 to 37. Any expenses which is allowed to in section 30 to 37 paid to a relative in excess of fair market value, such excess will be disallowed. So our act is not, sir, 40A and all different sections are. No, sir, it is an extension, tailpiece. It will start with the word notwithstanding anything contained in 30 to 37. So it should have been linked. Or tax has not been deducted or not remitted within the due date, 30% is disallowed in the case of payment to residents, 100% disallowed. So it should be first covered there. If it is not at all covered there, I am making a payment which is personal in nature. 37 itself disallows. Why should I come to 40? So tax has not been deducted. Hey, it's a personal payment. Expense only if I recognize it as expenses, there is a disallowance. When it is not at all, that's why I say it is a relatable thing. It is a relatable thing. Extension than tell all these things, people are not accepting what to do. There are 6 types of statutory payments which are spoken about in section 43B. 6 types. 3 to government, 2 to employees, 1 to financial institutions. Simply, for government, tax, cess, duty, employer contribution to EF, ESI, uh, superannuation approved funds. Railways for using their assets. For employees, bonus or commission, leave encashment. It's there, just listen, that's enough. For financial institutions, interest. There are 6 types of statutory payments. Access duty, employer contribution to statutory funds, railway for using their assets, bonus or commission, leave encashment, interest payable to banks and financial institutions. All these things, if they are due on 31st March, all these things, my dear friends, okay, due on 31st March, to allow the expenses, pay 1 month prior to the due date of filing returns. Okay, if you want it to be claimed, pay it. Okay, if not paid, if there is a power cut because of this, please stay back, I'll try to connect it. Okay, if not paid, if you are not paid, okay, disallowed in expense in the year of incurrence, allowed in the year of actual payment. If you have not paid these things, these are disallowed in the year of incurrence and allowed in the year of actual payment. This provision. This is what is the provision. 43B, the statutory payments has to be paid 1 month before 30th September. If it is not paid, disallow in the year of incurrence and allow in the year in which it is actually paid. In this, I want you to understand something. All of us, this is statutory payments. Straightforward, the adjustment will be there. Within bracket, they would not have given you disallow it. That's all. Don't worry. In this, I have said something about the interest in when we are reading section 41 itself. When we were doing section 41 itself, I have told you about interest. You remember? Waiver of interest by bank is not an income because you have already taxed it. You have already disallowed it. Am I audible, friends? Am I audible? Anyone confirm? So, with regard to statutory payments, if it is due, paid it before the 1 month prior to the due date of filing returns, claim it. If not, disallowed and allowed. This is a simple provision. For interest, we already saw in section 41 itself, if there is a waiver of interest, it will not be treated as income because it would have been disallowed in that year by the bank, by the tax law. The most important to understand is this employer versus employee contribution. Now it is part of law from the next year, no confusion at all, but even otherwise, various case laws has made it part of law. Employer versus employee contribution. All of us, please listen. Employee contribution has to be paid as per the due date under PF law, 15th or 20th of the next month. Employee contribution has to be paid before the due date under PF law. Where it is not paid, it will be treated as income. Where it is not paid, section 2, subsection 24, clause 9 or 10, it will be treated as income. If employee's contribution is not paid within due date, it will be treated as income. The most important subsequent payment you cannot claim it. Employee's contribution paid within due date. It is not your money. It is some other person's money. You paid that at least before the due date under the PF law. From his salary you deducted it. With the promise you will pay it in his account. Employee's contribution should be paid within the due date under PF law. If it is not paid, it will be treated as income. Subsequent payment, you cannot claim the deduction. Whereas employer contribution, you have time till 1 month prior to the due date of filing returns. Where it is not paid, disallowed, subsequent payment will be allowed in the year of. Big difference. Big difference. This was there in Gujarat Transport Corporation case law. Now as part of law itself, all other case laws you can turn it off. Kitcha Sugars, where they said for employee contribution also due date as per the income tax law. No. Very clear. Employee's contribution due date as per PF law, not paid. It should be treated as income. Subsequent payment, no deduction. Employer contribution due date 1 month prior to the due date, where it is not paid, disallowed in the year of incurrence and allowed in the year of actual payment. Please look through once. Please look through once. We'll quickly answer the disallowance provision. For disallowance, I have a very special question to you. Again, not from the examination standpoint, but from the overall understanding. When I come to that question, I will tell you. I have not shared the Excel yesterday. I thought I will complete a chapter and chat so that you will have a substantial amount to take it back. Company made the following payments to resident without deducting tax at source. What will be the tax consequence? Salary, non-compete fee, director fees. Will your answer be different if the company has deducted it in the month of April and remitted it in July 21? Computation of disallowance due to TDS default. Particulars, amount paid, disallowed. Salary to employees 15 lakhs, 30% disallowed. Non-compete fees 75,000, 30% disallowed. 30% disallowed. Directors sitting fees. Okay. I will take this opportunity to write a small note here. We will talk about it in TDS also. Okay. TDS under 194J. Any payment to a director which is not falling under 192. Any payment to a director which is not a salary, which is not a remuneration. Any payment to a director which is not a remuneration is falling under 194J. And interestingly, TDS liability from rupee 1. That is, there is no threshold for this. There is no threshold for this. More about this in 194J. 40,000 into 30%. Because even if they are given it as 20,000, I would have. Okay. Total disallowance in FY 2021. Total disallowance due to TDS in FY 2021 is 4,84,500. 4,84,500. Tax needs to be deducted in the same year of expenditure. Our friend says video is not clear. Is it so, friends?
No, sir, now become clear.
Now it's all right. Thank you. Okay. 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 Fine. Fine. Okay. If at all it's not clear, rain, net problem. I'm just connecting. Okay. Thanks for intimating. Good. Tax needs to be deducted in the same year of expenditure. If it is deducted in April 2021, if it is deducted in April 2021, still for FY 2021, it will be disallowed. Even though you have paid it in July, but you deducted only in April 21. So for FY 2021, it will be disallowed. This 484,500. However, the same will be allowed. That is, whatever is disallowed will be allowed in FY 21-22. During the financial year 2021, the following payments or expenditures were made, incurred by Mr. Yuvan a resident individual whose turnover is 99 lakhs for 31,320. Briefly discuss the disallowance. Interest of 45,000 paid to a firm without deducting tax at source. 3 lakhs was paid as salary to without deducting tax at source. Commission paid to a person without deducting tax at source. I have something very important to understand from somewhere else. I am bringing the provision. TDS, tax deduction, is applicable for all assessees except individuals and HUF. TDS provisions are applicable for all assessees except individuals and HUF whose gross receipt does not exceed rupees 50 lakhs or gross turnover does not exceed rupees 1 crore. TDS provisions are applicable for all assessees, but for individuals and HUF, when it will apply? Only if they are coming under 44AB limitation. If the gross receipt exceeds 50 lakhs or turnover, where the gross receipt does not exceed 50 lakhs, gross turnover does not exceed 1 crore, TDS provisions are not applicable for them. They need not deduct. Wait, I am not yet over. I have a lot to tell you. Gross receipts slash turnover is for the year preceding the previous year. For 2021, whether I should deduct tax or not, if I am an individual, for 2021, whether I should deduct tax or not depends upon what is my gross receipt or turnover in 1920. Once more, for 2021, whether I should deduct tax or not does not depend upon what is my turnover in 2021. Depends upon what is my turnover or gross receipts in 1920, preceding the previous year. However, TDS is applicable for all, even for the said individuals and HUF if the payment is for salaries. So this is only for 194. 192 you have to deduct. 192 you have to deduct. So on a continuous basis, I am telling you, the question has a very interlinked provision with the TDS, so we'll understand that also, taking this as an opportunity. TDS is liable, tax is liable to be deducted by all assessees except individuals and HUF whose gross turnover does not exceed 50 or 1 crore. Gross turnover of which year? Year preceding the previous year. In this case, Yuvan's turnover for 31,320 for 1920 is only 99 lakhs. Okay? In the given case, turnover of Yuvan for FY 1920 is not exceeding rupees 1 crore. Hence, he is not liable to deduct on interest or commission. However, Yuvan is liable to deduct for salary. Salaries does not have that exception. Where it is not deducted, 30% of such salary will be disallowed. Question number 15. Hurry, an individual carrying on business of purchase and sale of agricultural produce. He borrowed from State Financial Corporation and Indian Bank. He has not paid the interest as detailed. State Financial Corporation for the year 1819, 1920, 15 lakhs. Indian Bank for 1920, 30 lakhs. Both these entities restructure the interest into a new loan facility to be repayable in 60 equal installments for the year ended 31st March 21. 5 installments of Indian Bank and 3 installments of SFC are paid. Compute the amount of deduction that can be claimed under 43B for 2021. Read through the question. Interest to Indian Bank and State Financial Corporation would have been disallowed in the financial year 1920/1819 under 43B, as they have not been paid before the due date of respective years. 1920, 1819, whatever is this 15 lakhs, 30 lakhs would have been disallowed, which means it would have been taxed. Okay, as they have been not been paid within the due date of the respective year. In the current year 2021, according to section 43B, whatever is paid will be allowed. So it will be allowed on cash basis. It will be allowed on cash basis because in the current year, whatever is paid would be allowed. So for State Financial Corporation, I am liable to pay 15 lakhs. They converted it into 60 installments and I paid 3 installments to them. I paid 3 installments to them. Okay, so for SFC, okay, 15 lakhs divided by 60 into 3, okay, 15 lakhs divided by 60 into 3 for Indian Bank, okay, 30 lakhs, I paid 5, they also owe 60 installments, 30 lakhs divided by 60 into 5, 30 lakhs divided by 60 into 5, therefore expenses allowed in FY43B on actual payment basis. Sorry, allowed in financial year 2021 under 43B on actual payment basis is 75 plus 250. Other disallowance, don't worry, I will cover. 40A3, 40A2, I will cover. The provision is applicable in case of amalgamation, partition, etc., where if it is an asset, in one's book it is an asset, in another's book it is a stock. Then the cost of stock will be cost of the asset plus cost of improvement plus expenses incurred. Okay. So in one's book it is an asset, in another book's a stock. For the transferor, capital gain will come. They are talking about transferee. What will be the cost of stock? Okay. 43CA, I will talk about it in 50C, my dear friends. I will talk about it in 50C. 43CB, construction and service contracts. Okay, place of percentage of completion. Percentage of completion method is acceptable. This is what is set in ICDS also. Percentage of completion method. Okay. However, this is also for service contracts. However, if the period is not more than 90 days, let it be completion method itself. Only 90 days completion method. Otherwise, percentage of completion method. Discrete service. 3 months will be prepaid. 3 months prepayment of mobile bills. Take on time basis. On time basis, where the contract indeterminate method number of acts. I don't know how big the usage is going to be. Take on time basis. Take on time basis. Compulsory maintenance of books, not an important section for our final. Just know, for professionals, if the gross receipts exceeds 1,50,000 in all 3 years. For business, gross turnover exceeds 10 lakhs or gross profit exceeds 1,20,000 in any one of the 3 years. I'm not at all looking at these sections from our final perspective. Please, you know. This can be a question due to amendment. This can be a question due to amendment 44AB. If the gross receipts exceeds 50 lakhs for a professional, audit is mandatory, no change in the provision. No change in that provision. If the gross receipts exceeds 50 lakhs for a professional, audit is mandatory, no change. Where an assessee is opting for presumptive computation, want to declare a lesser income, we will see presumptive very soon. Then also audit is mandatory, no change. Where the assessee is opting for presumptive computation and want to declare a lesser income than what is specified, then also audit is mandatory, no change. To whom the change? For persons carrying on business or profession. For persons carrying on business. Profession, no change. For carrying on business, normally if the gross turnover exceeds 1 crore, you are subject to audit. However, if the cash payment or cash receipt, on the total payment or total receipt, not just turnover, total payment or total receipt does not exceed 5%. Next year it is changed to 10%. Then 5 crores. Then 5 crores. If your unapproved modes is less than 5%, both payment and receipt on the total payment and total receipt 5 crores. more than 5%, 1 crore. This is the amendment. Read through. Quickly, we'll answer that one question. I mean, page number 220, 220, question number 16. 220, question number 16. Preeti is carrying on textile business and the total turnover is 4 crore 50 lakhs. In the following situation, she seeks your advice on whether the books needs to be audited. If the whole turnover is through approved banking channel, where the turnover is only by banking channels, then the limit for mandatory audit is rupees 5 crores. In the given case, it has not exceeded rupees 5 crores. Hence, audit is not mandatory. If 90% of the turnover is through banking channel, 10%, where cash receipts exceed 5% of total receipt, then the limit for mandatory audit is rupees 1 crore. In the given case, turnover exceeds, hence audit is mandatory. %90 of turnover through banking, 5% bearer check, 5% cash. It has been clarified by the Finance Ministry and CBDT that 5% limit is for approved modes and not just cash. In other words, if the receipt through unapproved modes exceed 5%, then the limit is 1 crore. Expenditure, where cash payment exceeds 5% of total payment, then the limit for mandatory audit will be rupees 1 crore. In the given case, it has exceeded, so audit is mandatory. Can be a question, especially MCQ questions, it can be. Otherwise, okay. This is the last part of our discussion on the theoretical aspect. The last part of our discussion on the theoretical aspect is presumptive computation of income. Is presumptive computation of income. I would like to recollect what we studied in our non-resident taxation as the last part is also presumptive computation for non-residents. For airlines 5%, for shipping 7.5%, for lease rent of plant and machinery and construction 10%, 44B. This is presumptive computation for residents. At that time I told you for non-residents there is no turnover limit, but for residents there will always be turnover limits. Okay. The turnover should not exceed 2 crores if it is 44 AD. If it is 44 AD, my dear friends, the turnover should not exceed 2 crores. And presumptive computation is not for companies and LLP. They are supposed to maintain books, not under income tax law, but under their respective laws. They are supposed to maintain books. They are supposed to maintain books. So, other than companies and LLP, if any entity or individual has a small turnover of 2 crores, then he can opt for presumptive computation, declare 8% of your turnover as income, and if your income is through banking channels only, 6% of such turnover. No questions asked both sides. You declare and go off. 8% or 6% as the case may be. All expenses under section 30 to 37 or 38, 38 is partially asset used for business and not necessary, are deemed to have been allowed. Even unabsorbed depreciation is deemed to have been allowed because it is said in section 32. Even unabsorbed depreciation is deemed to have been allowed. You can set off business loss but not unabsorbed depreciation. That is also deemed to have been allowed. Where assessee wants to declare a lesser income, just now we saw tax audit. But wants to declare a lesser income than what is specified, come under 44 AB. Come under 44 AB. 44 ADA is for professionals. Threshold limit 50 lakhs and income 50% of gross receipts. Same conditions. All expenses are deemed to have been allowed. If you want to declare a lesser income, maintain books and get them audited. Same conditions. 44 AE is flying of goods vehicles. Okay, 44 AE is flying of goods vehicles. What is this? You should not own more than 10 vehicles. For HCV, HCV means 12,000 kgs or more. 1000 per ton. Actually, you can understand 1 kg, 1 rupee. Number of kgs into 1 every month or part thereof. Every month or even one day will be taken as 1 month. And non-HCV 7,500 per month or part thereof. Even one day will be taken as 1 month from the year of purchase. Put to use is not important. From the month of purchase, I will take it. From the month of purchase, I will take it. HCV means 12,000 kgs or more. They will have this. So 3 presumptive computation for residence SSC. Most popular is 44 AD. 8% or 6% up to 2 crores. 44 ADA professionals up to 50 lakhs, 50%. Vehicles 12,000 kgs or more, 1 kg, 1 rupee per month or part thereof. Other types of vehicle less than 12,000 kgs, 7,500 per month or part thereof. Even one day will be taken as 1 month. All expenses are deemed to have been allowed. If you want to declare a lesser income, go under tax audit net. The question where I have to comprehensively, I want to make you understand something. Question number 17. Comprehensively, we will understand 44 AD from various perspectives so that you are clear. Mr. Praveen engaged in the retail trade reports a turnover of 1 crore 98 lakh 50,000 for the financial year 2021. Income as per books of account 11 lakh 20,000. Okay. All transactions are carried out by way of account payee check, ECS, etc. This is the only source of income and was the first year he declared income under 4480. 1. Is Mr. Praveen eligible to opt for presumptive taxation from retail trade? Okay, let's go question wise. Yes, Praveen is eligible to opt under 44 AD. Okay, turnover has not exceeded rupees 2 crore for the financial year 2021. Hence, he is eligible. Yes, Praveen is eligible. Turnover has not exceeded, so Praveen can claim. If so, determine his income as per the applicable. Remember, all transaction are by way of account payee check, ECS or through bank account. So 6%, okay? Computation of income under 44 AD. Total turnover 1 crore 98 lakhs 50,000. Total turnover 1 crore 98 lakh 50,000. Income at the rate of 6% of such turnover. Income at the rate of 6% of such turnover. 11 lakh 91,000. 11 lakh 91,000. Okay? As the whole turnover is through approved channels. What will be the income if 50% of the turnover is banking channels and 50% through unapproved channels? Income 8% of turnover where the turnover is through unapproved channel. So on this 8%, 6% of turnover where the turnover is through approved channel. One three eight nine five double zero. In case Mr. Praveen does not opt for presumptive taxation, what are all the obligations? What is his income? 11,20,000 as per books. Where assessee is not opting for presumptive computation, offers income as per books, which is 11,50,000. Assessee is liable to maintain books, get them audited as the income is lesser than the prescribed limit. Whatever may be the case, maybe case 2 or case 3, in any case it is lesser, so you have to. In case Mr. Praveen does not, okay, what is the due date of filing in both the cases? Where Praveen opt for presumptive computation 31st July as audit is not mandatory. Where Praveen does not opt for presumptive computation 31st October as audit is mandatory. This is a big thing. That's why I said I'm answering all parts. Okay. If audit is not mandatory, 31st July. So, where you opt for presumptive taxation, audit is not going to be there. Turnover into prescribed percentage, so 31st July. If you are going to declare a lesser income, audit is mandatory, so 31st October. I will write one more thing, okay, where presumptive computation is opted for, then only last installment of advance tax is applicable. Okay, though we are going to study somewhere, I want to quickly browse through the provision where presumptive computation is opted. You are not liable to pay June, September, December installments 100% before last. Only last installment of advance tax is applicable. In other words, 234C interest will only be computed for the month of March. Okay, where presumptive computation is opted for, then disallowance provisions are not applicable. That is, if you have gone for 8% of a turnover, but you have made some cash payments, will the assessing officer disallow? No, because 30 to 37 expenses are deemed to have been allowed, not allowed, deemed. That's why I said 40, 43 and all is a continuation. Okay, when it is deemed to be allowed, where is the question of disallowance? So disallow, even if you have paid to relative, even if you have made cash payment, even if you have not paid the statutory dues, these can be claimed. Disallowance provision will not be applicable. Column gas, liability to deduct when tax payment is made to a subcontractor, but the actually payment you are liable to deduct. You are liable to deduct on advance, you are able to at the time of payment or credit, you are liable to deduct. Hence, assessee is liable to deduct, and failure to deduct will attract disallowance. Great city manufacturing can wait. Great city manufacturing, that is, if I pay remuneration as per section 40B also, that is sufficient. That will not be covered under 40A2. I will teach it in assessment of firm. Bonus to the employees is paid to the trust of the employees before the due date. It is subsequently paid after the due date. By paying to a staff welfare trust, you have fulfilled your obligation. The trust should be one where you cannot get back the money. That's all. If it is a proper trust, you have fulfilled the obligation, and the trust is ultimately going to benefit the staff. So, by paying it to the trust within the due date, there is no disallowance at all. You can claim the expenditure by paying to the trust within the due date. Sale, I told you, plant and machinery, waiver of term loan. Assessee obtained a term loan for plant and machinery. A part of the term loan is paid by the bank. That the waiver will result in the part of the cost funded by third person. It takes the character of subsidy, hence it should be adjusted with the cost of the asset. The entire money, whatever is the waiver, should be adjusted with the cost of the asset. Okay, I have removed the Gujarat transport case law because now the law itself says employees contribution. I have put there employer-employees contribution. Now the law itself says so. Honestly, we have completed up to this. Everything here, along with case laws, along with wherever small questions possible, not only small, we have dealt with detailed. Have the confidence that you know, that is enough for me. Have the confidence that you know, that is enough for me. A quick summation of ICDS. Only important things I'm going to mark for you. First thing you have to understand is what is books of accounts for income tax law. Books of accounts mean the statement of income that we prepare, add, disallowed, okay? That is what? The statement of income is known as books of accounts, my dear friends. For income tax law, the statement of income, you need not maintain separate general ledger, cash book, subsidiary ledger. The statement of income is known as books of law. Remember small guidelines, ICDS is not applicable for AMT or MAT, and ICD, if there is a conflict, ICDS, I mean law will prevail. If there is a conflict between ICDS and tax law, law will prevail. Very patiently, whenever you have time, you can go through this. Some of this are already covered. ICDS 1 is similar to AS1. Only thing is we don't cover the concept of materiality and prudence. Here there is nothing called materiality. Even 1 rupee matters for the government. And accounting policies will change while there is a reasonable cost. Reasonable cost is not defined at all. Is not defined at all. ICDS 2 inventories is typical to the inventory standard which you study, with two things to be noted. Borrowing cost will also form part of inventory cost if the time taken for conversion is more than 12 months. Borrowing, I don't know whether AS says so, but I'm telling you, okay, other things are as per cost or market price, net realizable value, whichever is less, cost is the same, the prime cost plus allocable overheads, fixed overheads, etc. Borrowing cost will also be included. Wine is the best example. The larger the period it is kept under the earth, under the sand, the more it gets into saleable value. So, more time taken to convert, borrowing cost will be added. And the second most important thing to note down is, in case of dissolution of a firm, inventories ought to be valued at only net realizable value. In case of dissolution of a firm, inventories has to be valued only on net realizable value. Inventory standard is also applicable for services. Whatever is the cost of services provided can also be, it can be taken as closing inventory. So what are all the things to remember? ICDS 1, materiality is not spoken, reasonable cost. ICDS 2, important points to remember. Also for service sector, whatever is the cost we should take. Borrowing cost will be also taken if the completion is going to be 12 months or more. In case of firm under dissolution, there is no cost or NRV, whichever is less. It is only NRV. Construction contract, just now I told you. Construction 43C. This is incorporated in 43C. So don't worry about it. Revenue recognition, same like your accounts, accounting standard. Sales, when the risk and rewards are passed on. Return of investment, when there is a reasonable surety. Interest on time basis. Royalty on accrual basis. Dividend only if it is declared and passed. Service contract percentage of completion method. Less than 90 days, full completion method, where service are indiscriminate, straight line basis. I told you mobile, prepaid, they will take it only on straight line basis. I haven't seen question here. Inventory, they have asked. Contracts, they can ask. Fixed asset, same like your fixed asset standard. Okay. All expenses to be capitalized. Spare will be capitalized if it is standby. Exchange of assets, fair market value of the incoming asset will be 10 lakhs, 1 crore worth of asset. You are allotting 5 lakh shares of 10 each. Is the asset value 50 lakhs? No. Entry is machinery account debit 1 crore to share capital 50 lakhs to securities premium 50 lakhs. Incoming asset where shares or securities are allotted, fair market value of the asset will be taken as the value, not the fair market value of the shares. Fair market value of the asset. If there is an incoming asset, the fair market value of the incoming asset should only be taken. Exchange rate difference for asset, for others like accounting, you have to do the expenses, etc. I mean, expense or income on restatement basis. Government grants, I told you, subsidy. Depreciable asset, adjusted with the cost of the asset. Non-depreciable, income. Any other subsidiary, income. Recognition, either due or receipt, whichever is earlier, when all conditions are fulfilled. However, it cannot go beyond the year of receipt. When it is received, you record it. Refund in the same manner. Just remember these things. Whatever I am highlighting, that's enough. More than enough. We have studied these things. Securities are again like inventory. AS 13. Cost or net market value, whichever is less. Cost includes everything. Only difference is AS, to find out cost or market value, you will see every security. Here under ICDS, it will be grouped and measurement will be done. All shares put together, all equity shares put together, cost or market value, whichever is less. All preference shares put together, cost, market value, all bonds, all debentures, all government securities. Whereas in accounting, shares of A Limited, shares of B Limited, shares of C Limited, shares of D Limited, each one you will check cost or market value, whichever is less. Income tax law always goes by the concept of block. Income tax law always goes by the concept of block. Block of asset means group. Block of securities. Group of securities compare. Block assessment we will study. That's the only difference. Borrowing cost. Qualifying assets like accounts. Inventory is also a qualifying asset. All borrowing costs should be capitalized till the asset is put to use. Till the date of putting it into use, everything will be capitalized. There is nothing called temporary suspension of activity, etc. Everything should be capitalized. Any income from the borrowings, it should be treated as income, important point, and it will not be adjusted with the cost of the asset. Any income from the borrowing, I got the loan and yet to pay the asset, keeping it deposited, whatever income I get in accounting standard, they will say adjust it, or I don't know accounting standard. They will say adjust it with the asset. Here don't. And the last cost standard is very important from the practical examination perspective, where this statement you should write, where provision is made on a reasonable basis, on scientific basis, then the same will be allowed. Very often repeated question in ICDS. Wages on the basis of past year negotiated and a provision has been made, allowed. Warranty on the basis of past experience, allowed. Provision made, allowed. Like that. 2 is important, 10 is important practically. Borrowing cost. Otherwise, ICDS is now slowly coming into main law itself. Don't worry. Okay? Whenever you have time, have a quick read through. Okay? You will be able to answer it. Oh my God. It is not practical approach to ICDS. It is, it is questions only. Comprehensive questions only we are going to go. It is not practical approach to ICDS. We are only going to go to comprehensive questions. 5 questions are only there. Okay, we will be able to answer and complete it. Okay. Don't worry. Am I only doing 5 questions? No. Assessment of firm is again PGBP. Assessment of companies is again PGBP. And so far we were only doing PGBP. We will be continuing to do. So don't worry, just 5 questions. No. I'll do more questions for you. You will, till you feel that I am very confident, I am unshakable in PGBP, I will not leave it. Don't worry. But not very difficult. I'll use the same page. Let's read it. Question number 1. Profit and loss account of Messrs. Suchitra Foods Private Specialities Limited disclosed a net profit of 79,40,800 after taking into account the following. Compute the taxable profit of the entity. The company has been split into various departments or units. During the previous year, the company closed down one of its units due to lack of profitability. Employees are paid severance cost, not VRS. Retrenchment sent out, which amounted to 1270. Allowed, my dear friends, allowed. Because it is not VRS. VRS only has to be amortized. Retrenchment cost is allowed. Training expenses paid to joint venture company. I'm making you think. When you read a line, you should think what the examiner is trying to ask us. Training expenses, is there any special provision? Paid to a joint venture company. Oh, they are coming to 40A subsection 2. They are coming to 40A subsection 2. Payment to relatives. It should be within the fair market value. Nothing given. So positive assumption. Favorable to the assessee. I assume that it is according to fair market value. Tax has been deducted and so it is allowed. Company paid 2,45,000 fees to director's son for higher education by entering into an agreement with the son of the director that after the course he needs to serve the company for 5 years. No such expenses are incurred in the past. XJ forging. Where director's son is the only beneficiary or the first beneficiary, it will not be allowed. It is like personal expenditure. 11 lakh commission paid to a director as the director has given personal guarantee. Allowed. Allowed. He has done something, so you are paying. Allowed. Company has incurred 9,40,000 towards replacement of dies and molds. Allowed. TVS Motors case law. Replacements are not new asset. It is just replacing an existing asset. Allowed. Painting money. First time painting the house, capitalized. After 3 years painting, repairs. Depreciation as per books, as per tax law. Company has incurred 8 lakhs on issue of convertible debentures. These are to be converted into shares after 5 years. ITC Limited. Expenses on issue of debentures is not to be amortized, fully claimed. Company has a brought forward loss of 16 lakhs and it is entirely for soft drink unit. Let's computation of business income of Suchitra Foods Limited for AY 21-22. $79 40 800. Adjustments. For everything you should write the note. For everything you should write the note. State the obvious. Severance cost paid to the employees of a closed down unit is an expenditure in the ordinary course of hence allowed. Only VRS compensation needs to be amortized. So no adjustment. No adjustments. Training expenses paid to a joint venture company is covered under 40A subsection 2. In the absence of information, it is assumed that the sum paid is in accordance with FMV and tax has been properly deducted. Hence, no disallowance. expenditure for director's son according to XJ Forging's case, where there is no such scheme, the director's son is the only or the first beneficiary, then it will be considered personal and not allowed. ₹245,000. Commission paid to a director for extending personal guarantee is allowed as the director has done something more than others. This is the case law also. Okay, it is assumed taxes deducted at source. In TVS Motors case, it is held that replacement does not bring a new asset into existence. Hence, such cost should be allowed. Depreciation as per books 17 lakhs. Depreciation as per IT law 14 lakhs. In ITC Limited, it is held that expenses on issue of convertible debentures are allowed as deduction as there is no specific provision to amortize the same. Gross business income. Gross business income. Brought forward loss. Loss from a discontinued business can be set off against continuing business. It's allowed, my dear friends. It's allowed. Net taxable business income. RST Limited engaged in the manufacture. So if at all depreciation is there, additional depreciation needs to be claimed. And sale of drug and pharmaceutical. Net profit after debiting or crediting is 28 lakhs. Income tax paid, always income tax disallowed. Legal fees in defending the title. So what? It is a normal course of business. Defending the title does not mean only at the time of purchase it should be disallowed. Expenditure in respect of scientific research, not land or building. In-house research, 100% allowed. Interest paid on arrears of sales tax allowed. Interest is allowed. Only penalty is disallowed. Only penalty is disallowed. Cash payment of 60,000 on a single day to a supplier. 30,000 pertains to invoice of 1920. No doubt the entire 60,000 disallowed, but it has to be split into two. 30,000 current year expenditure disallowed. 30,000 last year expenditure not disallowed, but treated as income. Treated as income. That is the difference. That is the difference. One is an expenditure, another is an income. Both the addition is 60. I accept. Amount payable for using railway facility, out of which 650 is paid in September, balance in November. Rent received for letting out of vacant land. Arrears of rent received in respect of a house property which was let out in the earlier year and which was not charged to tax 2 lakhs. The said property was itself sold. The company paid royalty to a foreign company 3 lakhs, which was disallowed in 1920 since tax was not deducted at source. The company deducted and paid the tax at source during the current year. Brought forward house property loss 40,000. Compute the total income of the company. Compute the total income of the company. Right? First, I will compute the business income. It's not at the time of legal. Normally disputes come. These are wherever you are not very clear, but wherever you are not clear what to write, but you know the provision. In the ordinary course of business, in the normal course of business, these are acceptable words. last year 150%. So we will add back 100% and claim 150. Now only 100%. Remember, interest is not a penalty. Interest under 234B, 234A, will you disallow? Yes, because income tax is disallowed. That's why that interest is disallowed. Not because it is a penalty. All income tax related things are disallowed. Here, it is not a penalty. Late compliance with the law. So interest will never be disallowed. (48) subsection 3. Current year expenditure where payment is in violation 30,000. Out of 60,000, current year expenditure which is in violation on a single day has exceeded 10,000, that is disallowed. Last year expenditure which was paid in violation of the said provision during the current year shall be treated as income. This 30,000 will be treated as income. Section 43B, usage of railway assets, payment not paid before or now not made 1 month prior to the due date of filing returns. Out of 9 lakhs, you have only paid 6,50,000. Balance should be disallowed. Out of 9 lakhs, you have paid 6,50,000 within due date. 2,50,000 will be disallowed. I will further write. This disallowed amount will be allowed in the financial year 21-22 as the payment is made in November 21. Whatever this 2,50,000, I can claim it in the financial year 21-22 as the payment has been made in November 21. Rent of vacant land taxable under IFOS, not business income, 1 lakh. 1 lakh. Arrears of rent taxable under IHP, income from IS property, 2 lakhs. These two are taxable. I'm not saying it. I'm only computing business income. Royalty paid to a non-resident during FY 19-20 without deducting tax at source would have been disallowed in that year. However, since payment is made during the current year, the default is rectified, hence allowed. You would have disallowed this royalty last year because payment as the tax has not been deducted at source. 100% disallowance because it is a non-resident. In the year in which default is rectified, you are supposed to allow it. Okay, so this you would have allowed this year. The question has asked us to compute total income also. Quickly we will complete that also. A time to recollect lot of things. At times slowly we will recollect. No problem. Relax. Where are you allowed to relax? Enjoy and do. Don't worry. House property. Arrears of rent received is taxable in the year of actual receipt. This is taxable even if the property is transferred before that date. Same in 41. In the income, bad debts recovered is taxable even if you have discontinued your business. Similarly, arrears of rent is taxable in the year in which you received the rent. That's what section 25 of the house property law says. Standard deduction at 30%. Brought forward property loss. The question says 40,000. Arrears of rent received is taxable only in the year of receipt. Ground rent, nothing but rent of vacant land. House property chapter will only tax house property rent, land and building opportunity. Vacant land rent will only be taxable in this chapter. Gross total income / total income. Question number 3. ILT Limited engaged in manufacturing pipes. Manufacturing. Additional depreciation if they ask. The profit and loss account of the company shows a net profit of 905 before depreciation. So we are going to compute depreciation. So remember additional. The following are furnished. You are required to compute the total income, indicating the reasons. All the questions I am working except the last question or examination questions appeared in the examination. So you can be sure of questions of similar nature only comes. None of the adjustment in both the question challenged you. Maximum you might not know how to write it, but it is not something which is very different. A group free air ticket was provided by a supplier for reaching a certain value of sales. The same is encashed on for rupees 10 lakhs in April 21 is adjusted with the reversals. Perquisites, whether converted into money or not, shall be treated as income. We need to pass the entry. It is the income of the current year and it should be passed in the current year. The regular supplier of raw material agreed for settlement of 8 lakhs instead of 10 lakhs for poor quality of material supplied during the previous year was not given effect to. Creditors returned back. Trading liability foregone. Section 41 deemed income. Section 41 deemed income. Andhra Bank sanctioned and disbursed the term loan for in 17-18 50 lakhs, interest 8 lakhs in arrears. The bank has converted the arrears of interest into new repayable loan of 10 installments. During the year, 2 installments was paid and the amount was reduced from the balance sheet liability side. It is allowed because that 8 lakhs would have been disallowed. Now we need to allow that 8 divided by 10 into 2. The company remitted 5 lakhs as interest to a company incorporated in USA on a loan taken 2 years back. Tax was deducted from interest and has been deposited only on 15th December 21. 100% disallowance because it is for a non-residence and allowed in 21-22 and allowed in 21-22. Liquidated damages of 3 lakhs received from a company for delay in supply of plant and machinery shown in other income. Saurashtra Cements. Saurashtra Cements case, where the compensation or liquidated damages directly linked to an asset. Then it should be adjusted with the cost of the asset. Then it should be adjusted with the cost of the asset. Sandeep, a sales executive stationed in head office, was on official tour to Bangalore on different dates. The company paid salary in cash, allowed, I told you, outside the base location if they employ. Now was written when this ATM, credit card, debit card was not there. Now is not yet amended to the recent electronic payments. So at that time they said if the payment, if he has gone outside, not in the base location, he is stationed in Delhi but sent to Bangalore, salary paid is allowed even if it is paid in cash. The company had taken up an initiative to restructure its debt and paid 20,000 to a company as premium, allowed. As per the scheme, 50,000 loan was waived against, directly credited it to the reserve account. No waiver of term loan should be adjusted with the cost of the asset. Waiver of term loan should be adjusted with the cost of the asset. The company has taken up initiative to restructure debts and 20,000 paid. As 50,000 loan was waived against its actually term loan, that is this is term loan. Okay, the in between word here is term loan. The company has contributed 50,000 to an electoral trust and stands included in general expenses. Disallowed 80 GGB can be claimed. Donation. Company has invested in equipment and for the purpose of research program to the extent of 18 lakhs. Consider the same as asset. 8 lakhs land will not be allowed. Building 11 lakhs will be allowed. Equipment 18, land will not be allowed. This 11 lakhs will be allowed. The opening WDV of plant and machinery as per income tax law is 11 crores. Company has purchased the new plant and machinery 9 crores and 11 crores in September and December, immediately putting them to use. And old machine was sold for 15 lakhs. Depreciation of all other assets amounted to 14 lakhs. Please read through the question. I just bring water. Okay. So from this question we will work tomorrow. But I have something very, very important to tell you. Very important for me to tell you this. This is the small place I request you to cooperate and work along with me is see these two tables in capital gain. How to compute full value of consideration and how to compute deemed cost of acquisition. I will explain you tomorrow. Before tomorrow's class, once read through these two things. I will explain you. I am going to do questions on this, but page number 235 onwards to full value. If you read through once, you will also get some idea about what we are going to work. You will be able to recollect, but I will ensure that everything I will work it out and also show it to you. Okay. So we will wind up here today. Tomorrow I will work out the 3 questions and walk into capital gains. 75% of capital gains will be over tomorrow, depending upon the number of hours we are going to sit. I know that. So that from Monday, we will be going into new arenas. Friends, I haven't left anything in PGBP. I can work out and show you so many questions that everything has been covered. Please feel confident that you know. If you go through that 25 pages, I thought of further condensing it. Okay, but then I thought you will not have the confidence that 145 pages a study material is there. He is saying 25 pages in a A4 sheet you read and that's enough. I have gone through that 145 pages and I have gone through all the past question papers. If time permits, I will work out some more questions also and show you in the last few days. To just tell you that we are on track in our preparation. We are not eliminating and reading. We are condensing and reading the crux. That's why the material itself is aroma. I'm a big fan of coffee, so it's a flavor of direct taxation, which is essential for us. Meet you tomorrow Time alone, I'll tell you.